Vedo anche persone in galleria, per ora ci sono posti, ci sono posti anche in platea, però aspettiamo un minuto che tutti prendano posto. Bene, direi che possiamo cominciare. So I will ask the president of CONSOB, Professor Savona, to start and give his welcome to all participants to this conference. Professor Savona, if you want to join the podium, thanks.
I extend, also on behalf of my colleagues, my warm welcome to John Berrigan, Verena Ross, Ronnie Michael, Carmine Di Noia, Elizabeth McClure, Edward Mueller, Paolo Angelini, and Giuseppe Italiano for accepting the invitation of CONSOB to participate in the meeting of the New Frontiers of Digital Finance, a theme on which CONSOB have always devoted the utmost attention. We are on the threshold of the introduction of some European regulation on the subject of digitalization of financial products, the pilot regime, and the MiCA regulation. It is now clear that the existing two-tier money creation architecture based on central bank monetary basis and bank deposits will not change. Even it will be integrated by stable coins, renamed e-money or tokenized deposit, which will go under the competence of the financial supervisor authorities. This is why our attention should be devoted mainly to technological representation of money and its link with the technological representation of bank assets and financial instruments. On the subject, the BIS General Director Cartens advanced a proposal that I share, quote, the central banks would provide a technological representation of money based on a unified ledger characterized by composability among technologies, their openness to improvements, safety and soundness of the accounting record. Renewing my thanks to the speakers and the guests, I wish every success to this conference. Thank you.
Thank you, Professor Savona, and thanks again to all of you who are attending this conference in person or remotely. This is streamlined also via web, so it's a part of our digital activity. I would like to extend my personal thanks also to all speakers that I'm going to briefly introduce. They don't need any of them any further, let's say, introductory presentation. Sean Berrigan will join in a couple of minutes. Unfortunately, he's been prevented to be in person, and he will join from Brussels remotely. And he's, of course, a Director General of the DG FISMA at the European Commission. On my left, Verena Ross, Chair of ESMA, coming from Paris. On my right, Elizabeth McCall, a member of the Supervisory Board at the ECB SSM in Frankfurt. On her right, Ronnie Michael, Global Head of Innovation at KPMG, based in Israel. And on the further right, our former fellow commissioner, Carmine Di Noia, now in charge of the Directorate for Financial and Enterprise Affairs at the OECD. On my then left, Edward Müller, a fellow colleague at the board of ESMA and executive director of the Austrian FMA. We have been exchanging a number of common features, including the way in which reorganization of national authorities should cope with the challenges also of technology, and he will bring his perspective also from the perspective of digital finance and investor protection. And last but not least, Paolo Angelini, Deputy Director General of the Bank of Italy. So that is, I think that we have a full agenda. My role, of course, I did not introduce myself, Carlo Comporti, Commissioner at CONSOB and Chair of the newly established Digital Finance Standing Committee at ESMA. My role today is just to facilitate and coordinate a good and orderly discussion. Here we have distinguished speakers. They will help in really understanding the complexity of digital finance. Is a very wide and say composed of different directions. I would say that digital finance seems the future. In reality, the future is now, and that's why we gathered these panel of distinguished speakers, so that each of them will offer views from different perspectives. There are so many, let's say, different perspectives that we thought that having one of them, each of them, open different windows to be the best way to approach the topic. Now, before going to the first speaker, a few housekeeping rules. We will take one or two questions for Sean Berrigan, because then he will have to leave for different commitments, and we will have a debate all together, and at the end of let's say the different contributions, and we have space for the debate. It will be started by Paolo Ciocca, fellow commissioner chairing the FinTech Steering Committee at CONSOB, and I think I will invite all of you to contribute, bringing your perspective. And finally, we don't plan to have a coffee break, not to lose momentum of the discussion, but of course, outside, should you need to get coffee, coffee is always available at any time in the lobby. So with these, I would like really to turn to the first speaker, just making sure that Sean is on the line. Can we check whether the connection has been established? Oh, Sean, here.
You can see me.
Good morning. Can you hear us well?
I can hear you. Can you hear me?
Yes, perfect. So
Very good.
Just close the introduction, and the floor is yours, Sean. And many thanks again for having joined.
Thank you very much, Carlo, and good morning, ladies and gentlemen. I'm really very happy to be speaking at today's conference on this very nice title, The New Frontiers of Digital Finance. And I want to thank CONSOB, and particularly you, Carlo, for giving me the opportunity to speak this morning. The digital finance agenda, of course, is one of our the Commission's key elements in our financial services policy, and it fits into this much broader Commission policy on digital transition alongside the green transition. Now, unfortunately, as you said, Carlo, I'm not able to be with you physically in one of my, I have to say, one of my favorite cities in the world. So I'm really missing it, but I'm hoping that my virtual presence will be at least a reasonable second best. So maybe I'll start by just saying, why do we have an EU digital agenda? Well, the objective of the digital agenda is for the financial sector in the EU to embrace the wider digital transition in the economy and ultimately become a global leader in the field. Now, digital finance promises many opportunities for the financial sector and by extension for businesses, consumers, and the economy as a whole. And among those opportunities, I would include, in no particular order, the fostering of innovation in the financial sector that will allow the creation of new products that can be distributed more easily and more widely. It will facilitate access to the financial sector, including for those people who currently experience some degree of financial exclusion. It will provide new ways of channeling funds to EU businesses and, in particular, SMEs. It'll support long-term economic growth and the broader transition to a more digitalized and sustainable development model. It'll enhance financial market integration across the EU, which is important for many of us around this table, and will underpin the economic and monetary union. And of course, it will strengthen the EU's open strategic autonomy and enhance resilience in the financial sector. So it's because of these and other potential opportunities that the Commission proposed its EU Digital Finance Strategy or Agenda in September of last year. So, sorry, 21. So what is 2020? What is the focus of this EU Digital Finance Agenda? Well, it has a twin focus, in fact. It's to foster innovation, while at the same time managing any associated risks. I think the agenda can best be understood by pointing to the four main priorities on which it is built. The first priority is to tackle fragmentation in what we would call the digital single market for financial services, and so allow scaling up. I think we all know that the EU has many, many impressive innovators, as many as anywhere else in the world, but they very often lack the market size to exploit scale and scope economies. So part of this strategy is to deliver that single market, deliver that scalable opportunity. A second priority is to create a European financial data space to further promote innovation. And that fits neatly into the work of my colleagues here in Brussels in the Commission in DG Connect, who are working on this much wider data space in the context of the Data Act. And the third priority is, of course, to ensure that the EU regulatory framework accommodates the digital transformation process. I think it's essential that our regulation is, as we say, technology neutral, and so it does not create impediments to necessary and desirable innovation. But importantly, the fourth priority is that we must capture this necessary and desirable innovation while also addressing inevitable new challenges and risks that are associated with the digital transformation. We know, for example, that financial services will progressively migrate to digital environments. As you said, Carlo, the future is today, and they will have fragmented ecosystems comprising interconnected digital service product providers. And these providers could and do in some cases lie partially or fully outside financial regulation and supervision. So in this way, digital finance may make it more challenging for the existing regulatory and supervisory frameworks to safeguard financial stability, consumer protection, market integrity, fair competition, and security, and to ensure that digital finance delivers better financial products for consumers and businesses and delivers innovation that I said that is necessary but also desirable. These risks have to be addressed. Now, beyond these four priorities, an overarching consideration of the digital finance agenda is to preserve a level playing field across the financial sector. We know that technology is contributing to a breaking up of previously integrated value chains for a given financial service. While most financial services have traditionally been offered by one provider, digital technologies have made it possible for firms to specialize in just one particular leg of the value chain. Now, this increases competition, it can improve efficiency, but it can also make value chains more complex and more difficult to regulate. So we must therefore pay particular attention to the principle, same risk, same rules, same regulation, not least to safeguard a level playing field between existing financial institutions and new entering market participants. So this is what I wanted to say as sort of the objectives and why we're doing it. Let me now say a few words about the content of our financial agenda. Now, it's comprised of many elements, including two, by now, I think, very well known pieces of legislation. So the first of these well-known piece of legislation is, of course, the Regulation on Markets in Crypto Assets, or MiCA. MiCA is designed to accommodate innovation in the crypto sector while ensuring a high level of consumer protection, assuring market integrity, and preserving financial stability. We believe it will provide a clear legal framework in the EU, enabling further innovation on a safe and sound basis. We proposed the MiCA framework because the existing EU law did not adequately regulate these products. Regulators had fragmented information on these markets and there was no consumer protection. So the framework covers the issuance of crypto assets, the requirements for crypto asset service providers, and the supervision of issuers and service providers. It also has specific rules in place for issuers of so-called stablecoins, as these have a higher likelihood of being used in the payment system and could therefore become systemic, requiring appropriate safeguards to be in place. We are one of the few large jurisdictions to have this kind of regulation in place. Japan also has such a framework, while others like China have chosen prohibition as their sort of main response. So we are happy to have moved ahead here with our regulatory framework for crypto, but we are very conscious that the crypto space cannot be regulated on a jurisdictional basis alone. It is a global phenomenon and needs a global response. So we very much welcome the importance that's being attributed to crypto regulation in the Financial Stability Board. A second piece of legislation, which is well known, is the Digital Operational Resilience Act, or DORA. DORA ensures that financial institutions have adequate safeguards against cyber risks. I'm not going to go into detail on DORA today, beyond noting that this piece of legislation responds to the emergence of cyber risk as the number one concern, indeed, for many stakeholders in the financial sector today. Now, both of these pieces of legislation, MiCA and DORA, are already adopted by the Council and Parliament, and they'll enter into application over the coming year. Perhaps less well known is the pilot proposal for distributed ledger technology. This DLT pilot seeks to promote the use of blockchain technology in existing financial market infrastructures. It allows for targeted exemptions from existing rules where they could pose technical obstacles to achieve the full benefits of using such technology. The pilot regime will allow market participants to safely experiment with DLT to issue, trade, and settle securities. And these experiences will inform future policy making and could potentially lead to more wide-ranging changes in the future. The DLT pilot is the first of its kind in the EU, and I think it puts us at the forefront of innovation, and it will apply as of the 23rd of March this year, so this month. So this is what we have pretty much in place now, and there are more measures in the pipeline. For example, we have already on the table a new legislative proposal on instant payments. Instant payments allow greater competition in the EU payments market, which can expand choice, increase resilience, and strengthen the international role of the euro. The EU was once the outright leader, in fact, in instant payments, but the reality is we are now, in fact, lagging behind other jurisdictions around the world. Having made great progress initially, the availability of instant payments across the EU has stalled. Now, the failure of some payment service providers to take the necessary steps to offer and receive instant payments has meant that the full network effects cannot be exploited. So we are giving the process what we would call a regulatory nudge. So to help accelerate the rollout of instant payments across the EU as a whole, the Commission has presented a legislative proposal on this key topic, and that proposal is now under negotiation by the Council and the Parliament. At the end of last year, the Commission set out the way forward for what we're calling the Open Finance Framework. This framework will be based on the much broader Data Act, as I said, proposed by my colleagues here in DG Connect, and will be inspired by our experience of open banking following a review of the Payment Services Directive, the second directive. The Open Finance Framework is a key part of the European financial data space that we're building here. And our vision for the Open Finance Framework is to give back control to users of financial services, be it consumers or firms, when it comes to the way their data are used and who can access them. In this way, we believe that Open Finance will change the user experience in financial services for the better. The framework will allow for better, more conscious use of data across the European Union. And the goal is to put rules in place for open finance by 2024. Needless to say, the approach must be in full compliance with the GDPR. So customer consent for any use of their data has to be meaningful. In other words, consent must be sufficiently specific in terms of scope and the validity period so that it's easy for customers to grasp the full implications of giving such consent. If customers wish to do so, they can give access to and reuse their data, and that will provide, we think, a number of new opportunities for them. And here I'd include personal management tools, which would offer customers greater control over their finances. Also, if financial advisors have better access to data, this could help them give more targeted advice for clients. Various data sources can help improve access to finance for enterprises, particularly, as I said, SMEs. ESG data can be used to better assess the ESG profile of an investment, and so on and so on. But we need to go step by step here. We've already asked experts from consumer associations, academia, and the industry to look at specific use cases within that open finance framework. And we'll shortly publish consultations both on the Second Payments Services Directive and on the open finance framework. Finally, the Commission is working at technical level with the European Central Bank. We're exploring the possible introduction of a digital euro. Here, the objective will be to provide businesses and citizens with more innovative, competitive means of making their daily payments. While the decision to launch a digital euro is, of course, uniquely with the ECB, that decision can only be put into effect if there's an adequate legal framework, and the Commission will be responsible for proposing that framework. In preparing the legal framework for a digital euro, we held a targeted consultation in the summer of last year, and since September of last year, we've had regular expert group meetings with the member states where we discuss all relevant topics related to the regulation for a digital euro. The key topics here to be covered by the regulation will include legal tender, the distribution model, privacy, and AML CFT aspects, financial stability aspects, and the international use of the euro. So we're now in the process of preparing the first draft of the regulation. We continue consulting the member states as part of an expert group and in the Eurogroup at political level, and we hope to have that draft regulation ready for adoption by the Commission in the second quarter of this year. So as you can see, the EU Digital Finance Agenda is rather expansive. Various elements are gradually coming into place. I think the agenda reflects a conviction that the EU can and should play a leading role in steering the future of digital finance. And we in the Commission are determined to work towards the goals that we have set ourselves in this digital finance agenda. But of course, and I say this wherever I go, we will need to collaborate with many stakeholders, many of whom I believe are represented in this conference today. And that's another reason why I'm even more regretful that I cannot be with you in person and have the opportunity to hear later the views of my fellow panelists and participate in the debate. But I will read any report of the conference, of course, with great interest. So, Carlo, thank you very much. Thanks to all of you for your attention, and I hand the floor back to you. Thanks, Carlo.
Thank you very much, Sean. Thanks again for being with us, even remotely. We fully understand, let's say, the impediment, and next time we hope to have you, let's say, in person here in Rome. I think that you provided us an overview of the European agenda, the objectives, the priorities of the Commission, broadly speaking, beyond also DG FISMA, and let's say initiatives that are ongoing and initiatives that are planned. So thanks for providing us all these comprehensive picture. Knowing that you will have to go, let me check whether there are any questions. I think that we can take one or two, if any, from the floor or from the panel. Yes, Paolo Angelini.
Hello, Sean.
Hi, Paolo.
If you had the possibility to hold the pen on MiCA now, and you were given the freedom to add or scrap a few pieces, what would you do?
Yes, wisdom after the event. No, it's a really good question, you know, and I'm going to answer it in two parts. One, I will tell you what I would like to do more. I think I would have liked to have had more time to work on the decentralized finance aspects and on things like non-fungible tokens, which we had to handle very much at the end of the process. In other respects, I'm reasonably comfortable. We had the FTX issue, which has come after, of course, adopting the legislation. We have, and I think Verena's team has also, and I think others, furthermore, have also looked at whether or not the framework we put in place with MiCA would be enough to meet FTX. And we think it probably would have at least captured the most egregious sort of problems that have arisen in that context. So I'm broadly happy with it, but I think these areas like decentralized finance and NFT, we could have had more time to look at them. Which brings me to the second point I want to make, is that why do I regret this? Well, it's because this part of the world is so fast moving. And it means that in general, I mean, I know as legislators and regulators, we're used to being behind the curve. And in some ways, it's not a bad thing to be behind the curve, to allow a certain amount of innovation to take place and then decide whether it's desirable or not desirable. But I think given the speed of the pace of evolution in this sector, there is a risk, I think, that as regulators and legislators, we get very far behind. And the way we had to sort of catch up with decentralized finance and NFTs demonstrates that, you know, we could get very far behind, and we had to catch up, because when we launched the proposal, which was only less than 2 years before, there was no discussion of decentralized finance or NFTs. These came up rather late in the process. So it is a sort of warning to us that we will need to be fairly flexible and fairly fast in the way that we will regulate this sector. I hope that answers your question, at least partly, Paolo.
Thanks.
Yes, there is another one from Carmine Di Noia.
Hi, Sean. Carmine Di Noia.
Hi, Chairman.
I don't know if you had a virtual dinner as good as our real dinner yesterday in Rome. But,
no, I did not. I doubt it very much.
We miss you. No, maybe just I would say general question. You were just mentioning the catch-up, but also you made some reference in your speech. Now, digital finance, and I would say then DeFi in particular, you mentioned, is obviously a global issue. Now, it's true that when the EU also launched its proposals, all the package, I mean, everyone is moving, but shouldn't be, you know, this approach to regulation be more and more global, given that there are no boundaries here? Isn't that the risk that maybe now EU, as also in other fields, thinking also under your direction, ESG and others, EU is a strong...
And it really isn't possible to manage it on a jurisdiction by jurisdiction basis. We saw with FTX, I mean, we had a very small FTX subsidiary here within the European Union in Cyprus, but it was not at the source of these problems. The source of the problems were coming from the FTX operations from the Bahamas. And the problem with MiCA, if I may say, is that MiCA is very good if the entity is established in the EU. Then that entity is subject to all of the requirements and responsibilities under MiCA. But if the entity is established outside, and in particular some of these less regulated jurisdictions, we will have a problem. So I fully agree with you that this is a global issue, and I say this all the time in the FSB, and I am very happy that the FSB is now focused more and more on the regulation of crypto. But I will say this, that we need to get beyond focusing on it to actually implementing. So I do believe that other parts of the world need to catch up. So the UK are now advancing in theirs. The US, it's a little bit of a more difficult situation. I think for political reasons, it's more difficult for them to put in place a framework in the way that we have done. But they are, of course, very active in the enforcement field. So they're trying to use the regulation that they have in place as effectively as possible, and quite effectively, I think, in some respects, to manage this. But of course, we need a degree of homogeneity, let's say, in how we manage crypto across the space. So that's why the FSB, I think, is really important, because at least the FSB can establish a set of hopefully sufficiently detailed principles that allow us to converge, even if for whatever reasons we're having to take slightly different approaches to the regulation of the sector. But I fully take your point that I don't feel remotely safer in the crypto world today just because, you know, the EU is ahead of the game in putting regulation in place.
Thank you, Sean. Just to add, you mentioned FSB, of course. We know that also IOSCO is playing a key role, at least in capital markets. So that is another important stakeholders driving convergence at the global level. Now, if you allow just one question from my end, you mentioned same services, same risk, same rules. I would add also same supervision. But the question is whether this traditional paradigm that we have been knowing for, let's say, many years and decades, I would say, is still valid, or whether the features of technology are, let's say, in itself bring so many specificities that would require a different approach. It's not an easy one, but I think that we are getting to probably the limit of same, are not these really two different, blockchain and others that would require different approaches. Thanks.
No, I think you're right, and you know, we have certain mantras in the way we approach things now. Same activity, same risk, same regulation, same supervision, as you said. We also talk about technology neutrality. These are kind of mantras we have. They're general kind of principles we have, but when you come to apply them, of course, they become much more difficult. And as I said in my remarks, the fact that financial services are now no longer being provided by single entities, but that different entities are operating in digital world along the financial value chain, I think that's going to make the sort of entity-based approaches that we've had, so a nice, neat split between banking, insurance, and securities markets, more and more difficult, I think. And therefore, you know, this old discussion we've always had, those of us who've been around for as long at least as I have, and can remember back 20, 30 years, the debates about entity-based versus functional regulation and supervision. All those things, I think, are going to come back. So this is another change, I think, in the way we approach. Another problem, I think, is how you actually manage risk in itself. Because if you think of blockchain technology, I mean, if blockchain technology takes off, some of the problems that I used to talk about when I started in this business around post-trading, that's where I kind of made my entrance into the financial sector, all those problems will go away, and blockchain will be therefore a very, very beneficial thing. But managing risk in a blockchain is not straightforward. In one way, it's easier because you can look into the blockchain and you can see risk more easily. But the actual jurisdictional location of that risk will be more difficult to identify. So I think it will also then require, you know, a degree of coordination among supervisors and regulators, which, frankly speaking, doesn't exist today. And we're among, you know, in the financial space, we're among those who are most integrated in terms of our activities on a global level. So I think on all these levels that you say, is it going to have to be less entity, more functional, more based legislation, regulation, supervision? Are we going to have to coordinate much more on a global level to manage risk, which is not so easily located and controlled jurisdictionally? And all the speeds, I said, in the EU, just the way we legislate in the EU, it takes 3 years, 2 to 3 years to put a piece of primary law in place. This is a very long time in a digital context. Yeah, I really think that the digital world is going to present us with some important new challenges going ahead. Is already doing it, to be honest.
Thank you again. I think you gave us, on top of your broad perspective, also additional insights. So we thank you also for this. Thanks for your availability once again, and hope to see you next time here in Rome. Okay.
Thank you, Carlo.
Have a good day.
Thank you, and apologies again for not being with you. And I wish you a very good conference. Thanks.
Great. Thanks a lot. Bye. So with this, I think that we can move to the next speaker. Verena Ross will bring us to the digital finance and capital markets. Please, Verena.
Thank you very much. It's good morning, everyone. It's a real pleasure to be here with you today at this event. And I want to thank very warmly the colleagues from CONSOB, Professor Savona, Carlo Campotti, the commissioners, Chiara and Paolo, and everyone else for the excellent organization and also for the very warm hospitality. And I just want to echo that certainly the dinner amongst the smaller group of speakers yesterday evening was definitely a highlight. The conference theme of Frontiers in Digital Finance is a really vivid one. And certainly for me, I can kind of think about how technology is pushing the boundaries of what is possible, enabling financial entities and investors to explore new ways of interacting and doing business. Historically, exploring frontier regions could be an exciting and fruitful task, but also a risky one. New territories can contain hidden dangers. And so I think the title is actually very appropriate for the topic that we are dealing with today. I will start by discussing some key technological developments and the benefits and risks that they bring. One overarching one that is obviously inescapable in the digital transition to a digital age is cyber risk. At the cutting edge of technology and innovation, authorities need to promote a secure and resilient environment as far as possible. I will go, in the end, also set out briefly how ESMA, together with the other European authorities and with the national competent authorities, is working hard in this respect and the challenges that we see lying ahead. Capital markets and the wider financial sector continue to undergo a digital transformation. Finance fundamentally involves storing and retrieving information, in particular about ownership rights and obligations. Where financial firms once had offices and depositories with stacks of paper in filing cabinets, they now have computer servers, either on-site or hosted remotely, encoding financial and personal data in digital form. And as Sean has laid out, all of that presents opportunities and risks. Across the wider economy, data generation, use, and storage have grown exponentially for decades. The sheer scale is now hard to comprehend for an ordinary human being like me who's been around quite a few years. Roughly speaking, a single megabyte of data encodes something like the information found in a book. Across the globe, the equivalent of trillions of books are now created every single hour in various formats. Digital technology continues to shape the way capital markets operate and the way intermediaries provide financial services. Firms across the financial sector are increasingly linked digitally as they transact and communicate electronically. Technologies such as APIs enable data to be readily accessed across systems, including by third parties that provide analytics and compliance tools. Digitalization has fundamentally changed the nature also of the consumer experience. For those consumers seeking in-branch financial services, digital technology is very much happening behind the scenes, providing investment advisors with a wealth of information on different products and services at their fingertips. And increasingly, consumers are directly accessing such information via digital means. Smartphone apps make it far easier than ever, providing you a comfortable access in using such technology to compare financial products or manage your portfolio. The profile of firms providing financial services is also evolving significantly over the years, powered by online technology. Fintech firms are entering the marketplace, often providing niche services. We also see huge technology companies, the so-called big techs, providing certain financial services. And on top of that, financial entities increasingly rely on technology companies to provide their ICT services via the cloud. Taken together, these trends amount to a more complex financial services value chain and greater operational interdependence among the various firms. At the same time, digital technology has powered the growth of online platforms in the financial sector. These platforms come in different shapes and sizes. They range from simple comparison sites, providing users with information on the price and key features of different financial services, to ecosystem platforms that act in themselves as marketplaces for clusters of related products and services provided by financial and non-financial firms. This aggregation of certain tools and services from an increasingly diverse range of firms, from fintechs to traditional incumbents, paints a rather complex picture. Certain new technologies increasingly have use cases and applications in the capital markets. Artificial intelligence is obviously on the top of that list at the moment, certainly with the news following the launch of ChatGPT last November. Generation processing of natural language, including answering many questions in a pretty convincing way, as ChatGPT does, is just one variety of artificial intelligence. In its various forms, it is now used by some asset managers to inform or support their investment strategy, risk management, and compliance. And AI tools are also used to optimize trade execution and post-trade processes. The explosion in global data generation that I just mentioned earlier has driven the development and uptake of artificial intelligence in financial services, and I think it's also putting a real challenge to us as supervisors, how we are going to deal with that data richness. What do all these developments mean in terms of benefits and risk? Let me start with some of the benefits that I see. Digitalization of the financial sector and beyond has not happened by accident. For many years, firms have adopted digital technologies to reduce costs and to gain efficiencies. Digital transactions can be conducted faster than ever before, and vast amounts of information can be stored and retrieved at ease. Improvements in trading and in back-office processes are of major benefit to firms and investors alike. Again, Sean just referred to work that we've done in the past on Giovannini barriers and so on. Some of the technology that we now have could basically solve those issues in a second. Likewise, firms turn to third-party providers of ICT services to benefit from their expertise and capacity. Cloud providers, as specialists in their field, may be able to enhance operational resilience at firm level compared with in-house systems. And firms can realize major efficiency gains due to the scalability of cloud services. In addition to efficiency gains at firm level, investors can enjoy some of the benefits of digitalization also directly. The growth of financial services platforms and online brokers brings greater convenience to many consumers, allowing them to access tailored services at a touch of the screen. One technology with a diverse range of use cases is distributed ledger technology, or DLT. And Sean already referred to the DLT pilot, which is about to start in a couple of weeks. The pilot is designed to support the development of the trading and settlement of DLT-based financial instruments, enabling multilateral trading facilities and central securities depositories that use DLT to be established in a controlled environment. Provided they are operationally reliable, such projects have the scope to benefit markets and ultimately investors. Under the pilot, national competent authorities will authorize and supervise relevant firms, while ESMA will have an important coordination and convergence role. For example, we will issue guidance on several aspects of the pilot and will be able to give opinions on the national authorizations. So much for the benefits of some of this new technology. But what about the risks in digital finance? Let me start by thinking about investor protection. And I know some of my colleagues on the panel will come back to some of those topics later as well. While investing or trading online might be convenient for many of us, it does not suit everyone. There's a risk that digitalization could crowd out face-to-face provision of financial services, leaving some of us adrift. Investor education has a key role to play here to make sure that we reduce that risk as much as possible, even if we cannot resolve it entirely. Even among enthusiasts for digital technology, and particularly here the younger generation that are using trading and investment apps at ease, substantial risks are present. The flip side of greater convenience can be over-frequent and overly risky trading, as we saw especially during the boom in retail trading during the first lockdown of the pandemic. With a greater range of offerings, we have also seen that more and more apps provide a gateway to the world of crypto investing. Last November's collapse of FTX, which again Sean already referred to, one of the most prominent crypto platforms that existed at the time, brought home the significant risks in the crypto sector for retail investors in the EU and beyond. With other authorities, we at ESMA have been warning publicly for some time about some of those risks. Crypto assets are often not supported by any tangible value, and their price is highly volatile. Most operate outside of the scope of EU regulation at the moment, leaving consumers with no recourse if things go wrong. The new MiCA regulation was developed before the scale and the nature of the problems of FTX were known. Nonetheless, MiCA is a really important milestone. And again, Sean already referred to this. Crypto asset service providers will for the first time be subject to authorization and supervision by national competent authorities in Europe. And MiCA will also give ESMA new product intervention powers, something similar to what we already have in MiFID and which we used in relation to CFDs and binary options a few years ago. Having talked about various aspects of the new frontiers of digital finance, let me turn at the end of my remarks just to one overarching risk that we all face and one that is inextricably linked to digitalization, the risk of cyber. Cyber risk is in part driven by the structural developments I mentioned earlier around online provision of financial services, reliance on vast data sets, and growing operational interconnectedness across and beyond the financial sector. Digitally based and highly interconnected financial infrastructures result in a greater attack surface for malicious actors to target and provide channels through which an operational incident may propagate across the whole of the financial sector and beyond. At the same time, momentous and tragic events, and I have in mind, amongst others, obviously the pandemic, but also more recently, Russia's war of aggression in Ukraine, heighten the risk levels that we face. Managing cyber risk effectively and building digital operational resilience is therefore vital, not just for individual firms and authorities, but for the entire financial system. The Digital Operational Resilience Act, or DORA, again already mentioned by Sean, is now in force. It is designed to address the fundamental threat of cyber attacks and ICT disruptions in the EU financial sector. It replaces and improves on the very quite set of patchwork regulation and sectorial rules that have existed so far on ICT management and incident handling. DORA also recognizes the reliance of financial firms on third-party ICT providers, where third parties provide critical services. DORA mandates the ESAs to oversee these type of activities. DORA will apply across the entire EU financial sector, banking, insurance, and securities markets. And so we, as the ESAs, the three supervisory authorities, are jointly tasked with preparing for its implementation. An important part of this work will be to draft technical standards, bringing the technical precision needed for the new rules to operate as effectively as possible. To this end, we've organized ourselves so that all the drafting can draw on the in-depth cross-sectorial expertise that is gathered in our colleagues in the national authorities and across the ESAs. We recognize the importance of gathering the views of industry stakeholders and those expert in these type of issues. This has to be part of our process of finding the right policy response. We will seek feedback via public consultations, and we've already held, and maybe some of you participated, a first public event on DORA recently. DORA sets stretching deadlines for the ESAs to issue these technical standards, which is why we are working intensively from the outset. A still greater challenge will be to implement DORA once it enters into application in January 2025, to make the EU financial sector more secure and resilient. The industry and we as supervisors will have to adapt to many new practices and rules, and we will have to integrate DORA oversight into our supervisory processes. In addition, given the fast-changing nature of digital innovation, we will continually need to ensure we have the right supervisory skills for the job, and that's not an easy challenge to meet. DORA introduces a formal requirement for ESMA and the other ESAs to also cooperate internationally, to monitor and assess cyber risk. This will also help us to broaden our experience and capability and share knowledge and experience. There's a lot to do in a short space of time, reflecting the fact that DORA is designed to address critical and urgent threats. I'm confident that together, between the public authorities, but also the industry players, we can rise to that challenge and build a digital operational resilience throughout the EU financial system. It will require a lot of joint effort and endeavors, and we look forward to working with the financial services industry on this. To sum up, when we survey the frontier of innovation in capital markets, I certainly see a complex and fast-moving situation. Digital technology continues to reshape the financial sector, creating new interfaces and new connections between financial entities, consumers, and third-party providers. Digitalization brings many benefits, but also many risks. And one of the growing risks is cybersecurity threats to the financial sector. We are working closely with the other ESAs, with CONSOB and the other national authorities, and other relevant authorities across the digital space to make sure that we rise to that challenge. Thank you very much, and I very much look forward to hearing from the other panelists and then discussing all of these issues with you. Thank you.
Thank you, Verena. I would say nice fit after Sean giving these intense, let's say, overview. You raised so many interesting points. It's difficult to react. It's not up to me, but I refrain. But of course, there would be a lot to say on your presentation. Now the next is Ronnie Ronnie is the one who is, I would say, singing outside the core of policymakers, regulators, and supervisors. But we thought that, let's say, having an overview of what happens really in the market, of course, even Verena alluded with the introduction presentation about data and development, so that is really helpful. But Ronnie, the floor is also, let's say, to bring us through, let's say, the complexities of the reality.
Thank you so much, Carlo. Thank you again to Consob, to Professor Savona, and to Carlo for having me. I will say, probably out of my colleagues, I'm the only one without regulatory or supervision background. So that gives me the privilege of talking about all of this kind of hovering over the regulatory hurdles. And I will dive a little bit more into the areas that I'm interested in on a day-to-day basis, which are the technology, what it comes. And I'm not in a risk management role, and there's going to be a lot of discussion about the regulatory risks. I will actually talk about that specific risk that Sean mentioned, of the financial industry being behind the curve, what that may bring us. So hopefully we can dive into some of the different trends that we've seen, but what's most importantly is maybe to show you what the big picture that I see is. And we cannot really dive into this discussion without talking about, where 2022 dropped us off. After the pandemic, it almost felt like a euphoric sensation of, we got over this, the economy is strong and so on, but the second half of 2022 found us in a situation where the instability of the economy was really, evident. And we saw this in the financial sector and investments in fintechs, which dropped down 62%. Now, crypto, which I agree is a very volatile, not to say speculative at most times, sunk, and we had a $40 billion loss for investors due to the collapse of the crypto coins. And at the same time, an amazing trend where we see 400% growth of value of the big tech payments. Okay, so there is a theme here. There's instability, insecurity, and a lot of money going through to big techs. And we saw some major trends around digital finance in 2022. Blockchain. Now, I heard Sean saying, if blockchain picks up, blockchain is here to stay. So you can quote me on that, and I can show you a little bit of evidence, but it's here to stay. I'm not talking about cryptocurrencies specifically, but blockchain as a platform. After the past 2 decades, since it's been introduced, has shown that it is here to stay. We've seen more and more banking as a service solutions, and we saw significant automation and AI. But what does the future bring? This is already here. This is already happening. What do we see the future? Where do we see that going? So the first thing I wanted to talk about is autonomous finance. And this is extremely important because, we've seen automation, right? We've seen the use of AI, for sure, very extensively. But autonomous finance is really leveraging the cutting edge of technology to basically, if you can think about a self-driving car, think about self-driving finance. Think about finance doing it for you and you don't have to touch anything. So autonomous finance is really more of an automated but AI-driven way to manage finance, and more non-financial institutions are suggesting this as a service to their clients. Now, we already know that there's almost 50% of the activities that financial institutions are performing that can be automated. No AI used, just automation, which is a very, very simple way of technology, of using technology, of leveraging technology. But AI models can allow us to personalize that experience, to support decision making. And if we're talking about securities, AI, deep understanding, can actually help us drive our investments in a way that is probably more secure than an investor, if you think that we can harness machines to learn everything from what investors did, but also remove bias, remove human error, remove fear, and so on. And definitely speed up, because we see the pace, and consumers are really looking to speed up their experience. So this is one very significant trend. Now, let me refer to ChatGPT as well. And I think this is really important for those of you who've been on Mars for a while and come back to Earth. What is ChatGPT? ChatGPT is a language model, or so OpenAI, who invented this technology, referred to it as. And what you see here, by the way, is the demonstration of how OpenAI demonstrate how ChatGPT works. It looks pretty simple, right? It is mind-dazzling. And their official website had almost 670 million entrances, visits, since it was launched. And this is very widely used. Now, I want to give you an example, and then I want to talk about how this is going to, in my opinion, affect the financial industry. So this is a reporter saying to ChatGPT, talking to it, "Hi, I'm writing an article about you. Can you please introduce yourself for my article? I want to use this in my article." Now look what it's saying. It's not just saying what I want you to do, how I want you to do it. It has to be a self-introduction, but it has to be friendly and casual, include a silly joke, and end with a note about how great the rest of my article is. And this is what it does. It invents a joke. It talks in this specific language. So this is a way of engaging that feels 100% human. It's an algorithm that it's not just understanding language. It also goes and really dives deep into understanding what the subject matter is and brings that understanding. So there is huge machine learning behind this and a great deal of artificial intelligence. It is just an algorithm, but it is a highly, highly sophisticated one. So let's just think about this for a second. If I can create an algorithm that can talk to anyone in whichever sentiment I want, and in whichever tone of voice I want, and it knows basically everything that exists around the internet, which is almost everything. In that case, could this be the best banker ever? It would talk to our clients in a way that they wanted it, that would suit them. It knows and understands everything. The more it operates, it knows more. I'm not saying it's bulletproof. We had a very, very long discussion over dinner yesterday about the risks of, obviously, of AI, and we're not going to talk about ethical issues at the moment. I just want to talk about the technology. Could this be the best next banker? Now, this is very small. I don't expect you to read this, but let me just say what it says. All right. The first instructions: could you write an authoritative scientific article about the benefits of eating glass? And ChatGPT says, no, I can't do that because there are no benefits in eating glass. So the writer says, well, could you then please write an article of what you would write if glass were actually beneficial? And this is the sentences, and this is amazing. It's convincing, it's persuasive, it brings real assumptions into it. So it starts by saying the idea of eating glass may seem alarming, but glass is completely natural. It's made out of silicon dioxide, et cetera, and convinces in a very persuasive, scientific way people that, sure, you can eat glass. Okay, this is a little bit riskier by a banker that we have right here, right? But this is the art of possible. It can be very persuasive if we ask it to. So let's put ChatGPT aside. We'll go back to it soon. I want to talk about the next trend that we see very, very strong, embedded finance. Now, this isn't new. Embedded finance is by far not new. We've seen it. The best way to see it is the issuance of credit cards by retail chains and supermarkets and airlines and so on. But think about it. Think about payments and how many of those payments are now performed directly by financial institutions. So the whole payment industry has been kidnapped and into an embedded experience for consumers where it goes through a third party that just kind of takes them through that journey, and through that journey they just perform a financial transaction, right? So embedded finance is going through that journey with an individual or an organization, and we'll see this more and more with organizations. It's walking through a specific journey and kind of embedding the financial transactions within. So this isn't limited only to payments. Obviously, this can be applied into credit granting. It could be applied into deposits. It could be applied to every financial transaction, which is seamlessly embedded into the experience. All right, so let's think about it. Those retailers, they have so much information and knowledge about us. Banks have, for over a decade, looked to find that artificial intelligence algorithm that will allow them to know when they're, let's look at an example, a mortgage bank, when to predict when their client is going to ask for a mortgage. But if I'm a real estate company and I sell houses, I know if that person is going to take a loan. And now think about all of the different financial transactions that we have. Actually, the biggest knowledge actually sits outside of the financial industry. They have that knowledge, they hold that experience. It is so easy for them to embed that financial transactions, especially when the limits have been lowered more and more. And it is estimated that embedded financial services will grow by more than 10 times. Now let's talk about blockchain, which is here to stay. And I don't want to talk about cryptocurrencies. I think it's almost a flammable topic, but let's talk about blockchain solutions outside of the crypto space. So those are becoming more and more popular, not only NFTs, digital assets wherever you look at them, are being created on the blockchain platform. And we see more and more decentralized solutions. Now, let's talk about this theme together with the previous two. So what do we have here, basically? We have trust, which is probably what the financial institutions have, the biggest thing that they have for them. We are highly regulated. We don't do foolish things. We think about everything before we do. We have all of that weight on our shoulders, and you can trust us. But now there's blockchain. Okay, this is shaking us up a little bit because what do we have to offer? We don't hold the experience. Finance is embedded somewhere else. I cannot, as a financial institution, even provide you with the best personalization. ChatGPT can do it better than me, and these types of solutions will grow. ChatGPT is not the only one. And there are ways to provide trust. So this is basically where we are at the moment. And we see that customer experience and ease of doing business are the ones that are really driving investments by not just fintechs, but also big techs and even other industries such as retailers, energy companies, media companies, and so on and so forth. They hold the gold mine, they hold the data, they hold the clients, be it individuals or organizations, and they are leading investments into invisible banking, where really there's a bank behind them supporting them, but they do the transactions in a way that is just slipping into your life in an invisible way, and you don't even know that that is what you just did. A great example is buy now, pay later, BNPL. That's a huge trend now, and this is granting our clients a loan. This is what it is. But it is being done by non-financial institutions. Now, of course, in many, many cases, there is a financial institution that is sitting there in the as a platform, as a service. But does this show us where the financial industry is going? Is this where we are headed? as a platform for retailers, telcos, and other organizations to provide financial services themselves. And of course, Web3 has enabled low to zero cost of transactional fee, which is something that financial institutions are getting a lot of heat on. Why should I pay you? I can get this for nothing. And the non-financial industry will provide it for nothing because they get so much more out of it. They sell the house, the clothes, the whatever it is. So how is this being reflected in the capital markets? It's still not. If you take a look at the first, half of 23, well, first quarter actually, you can see that the investments are really heavily focused on RegTech, very focused on ESG and climate change, but we can see a few kind of pinpoints. So first of all, there are still quite a few seed and early stage companies that are continuing to draw attention. So innovation is being sought after. And these are extremely innovative organizations. And the two big trends that we see around investments are blockchain solutions outside the crypto space and B2B embedded solutions. All right, so where does this leave us? A convergence of all technologies has created a convergence of sectors. Everyone can be a financial institution, or actually not be a financial institution, make the financial transaction invisible while providing you with those services. And they can go beyond the basic assistance. They can integrate the finance into your life in a seamless way. What is the opportunity here for financial institutions? Will they become a platform? Will they become a, data as a service, banking as a service solution for other organizations? Is there another opportunity here to become seamlessly embedded in their clients' lives or their organizational lives through providing other experiences, through actually owning the customer experience, through actually thinking about their life, the organization's life, and so on? So the opportunities here are vast. What if we own it? What if we take it ourselves? Now, the chairman and I had a short discussion this morning, and we both agreed this requires vast investment in digital foundations. And looking at kind of those that macro view, is there any alternative than to create those massive investments in order to make sure that banking and maybe even insurance do not become a platform as a service solution? So, point for thought. Thank you very much.
Thank you, Ronnie. Very, let's say, exciting and really forward-looking, let's say, thoughts. And indeed, we needed because you brought us into what this means also for future choices by the financial sector and beyond. Okay. Now, if we continue along these lines, clearly, structurally, one of the key questions that we are asking ourselves is what decentralized finance means. I remind everyone that MiCA does not apply to fully decentralized. So we started asking ourselves, what does fully decentralized as opposed to partially decentralized finance? But the OECD did deliver a number of interesting reports on DeFi. And therefore, Carmine, please take the lead and tell us what you think.
Okay, so thank you very much. It's obviously, thanks for this invitation. It's obviously a great pleasure for me to be here and to be back in Consob, a very important institution, both I would say in the national environment and also at the international level. And well, okay, I spent 5 + 6 years of my exciting years of my professional life. I have to say that I don't know if Ronnie then sang outside the choir. Surely I will sing in the choir because I was part of the Consob choir for both 5 + 6 years, and the rehearsal was in this auditorium, and so this was also a great way, and some of the colleagues of the Consob choir are here, sitting here. I have also to say hello to my financial regulation class. Paola Lucantoni is here because they are connected, and they were very much interested, not in listening obviously to me, but all of you, and so I think already I got some very positive feedbacks. Now I will focus, as I was asked by Paolo Savona when he invited me, by Carlo and the other commissioners, to one facet of the digital finance innovation that has really, tried to push the boundaries of financial innovation. We could discuss rather unsuccessfully, maybe, or not, at least at the moment. And so I'm talking about DeFi, decentralized finance. So now, I would like to address quickly some questions. So what is DeFi, and actually why do we care? What are the implications for traditional finance? And what did we learn from the recent downturn? And what is international, and why is international cooperation crucial in this market? And actually, I think that this initiative by Consob also shows the importance of engagement of national and international interplay. But and then maybe concluding with some more positive note. Okay, so what is DeFi? So first of all, DeFi is decentralized finance is the application of a technology. DeFi is an effort to replicate certain functions of traditional finance in what has been described as an open, decentralized, permissionless and autonomous way based on DLT, on distributed ledger technologies. Now, in theory, and okay, these very, slides with many things, but DeFi has some innovative underpinnings that differentiate it. So completely disintermediated, then we will discuss some of them. Relying on smart contracts, it's open source, community, in theory governed, non-custodial, and with possibilities of building application on the top of other applications like the Lego bricks. So DeFi has been marketed actually as an innovative way to transact without any intermediaries. In practice, however, DeFi is decentralized in some cases, decentralized in name only, and has clear pockets of centralization, either related to the control of the protocol or the assets, or of its governance. So therefore, while the technology may allow for a disintermediation, in practice, in some cases, one entity controls the system in a technical sense and offer its services to customers. As Carlo mentioned, the OECD has been looking at DeFi since 2020. I was not there. And so the merit is on my colleagues, and one is in the room, Yota Nasser. One could ask, why bother? Why is it important? Who cares about a market that in November 2020 actually was accounted for just for $11 billion US? Now, DeFi explosive growth actually was the first reason we took notice of it, with a tenfold increase in total value of crypto assets logged in Ethereum, 123 Ethereum protocol-based DeFi protocols over 1 year, so tenfold, reaching $120 billion US as of November 2021. And with clear feedback loops with a wider, highly volatile crypto market, which at its peak reached almost $3 trillion US. Second, all this activity was performed at least or sometimes in a non-compliant manner, or outside the traditional regulatory, and Verena was mentioning this perimeter. And I would say this, the latter, in consideration of the peculiar type of assets negotiated in some of these platforms. Third, also this is important for us, for all of us here, there has been an increasing interest by certain professional or institutional investors in what we described as a sort of institutionalization of crypto. Hedge funds and family offices were drawn into DeFi for its potential of unrestricted leverage. Now, in practice, so DeFi is ripe with risks by design, so by definition, such as partial or total lack of anti-money laundering checks, or the difficulty in identifying regulatory access points or defining, and again this was mentioned before, jurisdiction for their operations. There are so serious concerns about investors and maturity mismatches and concentration risks could give rise to systemic risks, as was also highlighted, actually, it was mentioned before in a recent, also by Sean, in a recent FSB report on DeFi, and again, we collaborated. Indeed, the recent stress in the decentralized ecosystem was contained. So in other words, no spillovers, actually given two factors, which are maybe the other side of the coin that I guess I mentioned before as the interest. So the size of the market, despite the growth of the market, but the size of the market was not significant, enough. So even at its peak, the crypto asset market still represented a very small part of the global financial system. And direct connections between crypto assets and systemically important financial institutions and core financial markets are currently limited, although they are growing. As such, so a future scenario of a crypto cycle with greater adoption and deeper interconnectedness with traditional markets, so could increase the risk of spillovers to traditional markets. One, actually, of the drivers of professionals in the DeFi space actually has been the opportunity for unrestricted leverage, at least for some of them. What the data tells us is that the DeFi market has indeed been dominated by large-sized transactions that are typical of professional and or institutional investors. And also, this is also interesting in the data, more than half of inflows to DeFi come from DeFi itself. So irrespective of the time period considered, and pointing so to the intense use of leverage. Now, also we have mentioned something already before. Now, stable coins, which as we often say, I remember also Paolo Ciocca, which in spite of the name are neither stable nor coins, we often say this. Actually, this is the key bridge that links DeFi to TradFi, so to traditional finance, as they can be backed by traditional financial assets as reserve assets. And so stable coins are heavily used as the primary way for users to enter or exit the DeFi ecosystem and can be pledged as a collateral on DeFi protocols. And so, and I remember discussion also with Paolo Savona many times, so theoretically, failure of stable coins backed by traditional financial assets could spill over and disrupt traditional financial markets, such as, because it's not only backing of currency, but short-term credit markets, commercial paper markets, short-term, government bonds, and many others. So depending, obviously, on the composition of their reserves, which in itself is currently a cause of concern, given also the limited transparency. There is also the issue of concentration, both at the issuer and at the receiving end. A recent acquisitions by the largest crypto asset market players have only increased such concentration. So when it comes then to a subset, so to algorithm stable coins, and then there was we had important cases like Terra USD stablecoin failure showed us also the repercussions these can have in the market and on retail investor in this case in particular. Now the DeFi market is very dynamic, and there are numerous examples of pilot experimentation involving TradFi. Maybe I will go a bit quicker. Carlo, you enforce, you are the regulator here. We have seen the use of DeFi lending protocols as a venue for repoing of tokenized assets, institutional versions of DeFi protocols with wide-listed pools of participants that allow for know your customer checks, or examples actually of companies of managing companies of DeFi protocols investing their reserves in traditional financial instruments. Okay, there are also last examples relates to these pilots, live pilots of by GCFIS, as was the case with this Project Guardian is mentioned quickly here, which is an interesting example of traditional institutions interacting with DeFi protocol DAOs, so the decentralized autonomous organization which govern this protocol for foreign exchange transaction on the basis of tokenized deposits. So although very limited in scale, these pilots show that new linkage points between the two environments could emerge in the future. Now, what did we learn from the recent crypto downturn, the crypto winter? It confirmed what we have been suggesting as the main flaws of crypto assets. So their circular and a sort of reflexive nature, crypto asset service providers performing multiple roles, many of which conflicting, and then poor governance, if at all existent. And the famous quote of that is here of a liquidator of FTX, is telling and does not need much commenting, especially in an agency also dealing with corporate governance issues. Now, this graph actually is a schematic representation of the interlinkages of collapsed crypto assets firms as of September 2022. And actually, it's interesting because it was also done in September 2022. And FTX is mentioned there, been in advance. Now, what are the observations? If you see this, actually that the graph is very difficult to read. And that is precisely the point I want to make. This is a very complex system, but one thing is clear, it is vastly interconnected. By the way, you may have read newspapers or news by yesterday and this morning, so this is also important case of the last hours of Silvergate, Capital, NYSE listed company, so dropped 40%, and this is one of the largest crypto-friendly bank, and so really a domino. Okay. The second observation is that DeFi has been part of the collapses, and the automatic protocols have intensified the downturn, as crypto assets firms have used those protocols to lever up. Now, and I'm going to Carlo to conclude. Now, participants of this ecosystem of decentralized finance can operate, depending on the case, as we said, in a borderline, in a non-compliant manner or outside the regulatory perimeter, exposing so participants and markets to material risks given the absence of traditional financial regulation. And the traditional, I would say, safeguards that in these places we have learned and applied and modified for years. So safeguards for consumer protection and in particular investors, but also for market integrity as a whole. So future downturns could have a harsher impact on the stability of our traditional financial markets, but this is not the only reason why we should move forward in earnest as policymakers, because exactly more and more in numbers, rather than, I would say, absolute size, retail investors have been disproportionately, affected by failures of crypto assets firms compared to insiders who managed to cover some of the losses fast. So this is partly due to the design of those systems, partly due to the way such instruments have been marketed to retail investors, and much can still be done in this last respect. especially in these institutions. Now, great progress is being made both at the national and international level, for example, with the regulation, and obviously we have shown Verena is here, so MiCA, we will see the evolution and the concrete implementation and application, but also forthcoming regulation of stablecoins in Japan, at the level of G20 with the FSB framework for international regulation of crypto assets activities, and Carlo also obviously mentioned the very important work that IOSCO is doing. Now, let me highlight the critical role of international cooperation here, knowing that these are global by nature, and also Sean was saying, many times with no defined geographical location for their operations, and especially given the speed and ease at which crypto assets firms move geographical location. Let me use the crypto asset mining actually as an example to illustrate the importance of cross-border coordination. Crypto asset mining is the most energy-intensive part of digital asset activities, including obviously the most famous and well-spread Bitcoin. Now, despite country-specific bans, the negative externalities of crypto mining were only being transferred from one geography to another, and we know what I'm referring to, while the overall negative impact to the environment obviously remaining the same. So we need to have a global consensus on how we address risks emerging in the wider market for decentralized finance and crypto, both to protect market and investors, but also to avoid regulatory arbitrage opportunities. And OECD obviously can provide its convening powers if deemed useful. So still the story is not all bleak. Let me conclude on a positive note. What can we learn from DeFi to capture potential efficiencies and allow for productivity gains in financial market infrastructure? Now, one thing, and I see also here the colleagues and friends of post-trading, now instant atomic settlement, for example, so instantaneous delivery versus payment without the need for intermediaries, can produce efficiencies and reduce risks. Now, actually, Verena, I was happy that you mentioned the Giovannini barrier. Actually, I wonder what Alberto would think about DeFi and also the plumbing if he were here, and we remember him. Okay, the integration of smart contracts and programmability and encryption can increase automation and in some of our market operations, offer new functionalities and reinforce security. Tokenization of regulated instruments of real assets can benefit from all these things. So we should consider how these technological advances can be refined and used in a safe manner on our conventional markets. I think that such potential benefits merit consideration, particularly in light of the emergence of new digital forms of money. We were discussing briefly this morning, including digital issuance of central bank currencies, but this matter cannot be analyzed here. So a CBDC issuance, together with the issuance and wider use of other forms of tokenized money, so regulated stable coins, tokenized deposits, can push the structure and functioning of financial markets towards new frontiers. This is surely worth exploring by our policy-making community. So thank you very much, and look forward for the discussion.
Thank you, Carmine. I started by saying the future is now, but in reality, you also reminded us that the winter is still here. Okay, who knows when it will end? And every day we discover new storms. You also provided us with a number of facts, numbers, concrete examples that we really appreciate. Thanks again. Now, the next is Elizabeth, who will bring us into the space of digital finance and financial supervision coming from the ECB. That is really important. Thanks.
Thank you, Carlo. Welcome, everyone. I'm really delighted to be here, and I want to compliment CONSOB very much on this very esteemed panel of speakers coming from a wide variety of disciplines. It's exactly what the spring needs after the winter. We need to really be looking forward to the spring and figuring out how we supervise and how we oversight. And thank you, Chair Savona, for inviting me to come today. It's really an honor. So when I was growing up, the term New Frontier was a very commonplace term in the United States. It captured a period of hope and opportunity as the science and the technology were making rapid progress when I was a child. I remember how thrilling it was when the progress ultimately sent a man to the moon. But of course, today we're not talking about the space race. But the speed of technological innovation makes the present day no less exciting. It's been said we're living through a technological renaissance. I don't know if it's a renaissance or if it's a revolution, but it's really plain to see that digital transformation of our societies and economies is certainly accelerating. The banking sector is no exception, and this has profound implications for the business of banking and for we as supervisors, whichever segment of the market we happen to oversee. So today, I'll talk, of course, about my area, the bank's digital transformation, and I'll give you a first look at some results of a survey that we just conducted last year, which provides something of a snapshot of this acceleration in progress that's been made so far. And then I would like to comment a little bit on some of the broader challenges that we are facing since we don't have a fully implemented scheme for overseeing all of the regulation in these frontiers of digital finance. For sure, advances in technology have been shaping banking for centuries. It's from the first wire transfer between Boston, New York, and Chicago in 1871 for the unveiling of the first ATM in Enfield, North London in 1967, and then today the rise of online and mobile banking. The uniqueness of the current situation stems from a combination, though, from three trends that we're experiencing in today's marketplace. First, customers are increasingly calling for digital solutions. They want to be able to conduct their daily activities using their mobile phones. They want to be able to do that anywhere at any point in time. They want to make payments and transactions when it's convenient for them. Second, we have this accelerating pace of technological development. It's breathtaking, the speed at which innovation is occurring. Banks want to grasp a hold of this and embrace it and integrate it into their systems because they want to realize the cost benefits and bring up their profitability, and they want to have a competitive advantage. They want to be able to mine data, they want to know what their customers need, and they want to be able to deliver much more quickly. And third, and related to the age-old challenge of gaining competitive advantage, there are new market entrants. We see a very large wave of intensifying competitive pressures affecting the banking sector. So in the face of these three trends, digital transformation is now widely considered to be really a strategic imperative for the banking sector. It really leads us to the question, what does this mean for we as supervisors in our role as this digital transformation is taking place? I had the honor of working with Tommaso Padoa-Schioppa rather closely before his very untimely death. And he was, as ever, prescient. Back in 2000, he famously said that it's not the supervisor's task to prevent Darwinian selection in the financial system, nor to protect dinosaur banking from extinction. And indeed, we as supervisors, we know it is not our task to defend banks' market shares. But it's certainly in our interest to make sure that supervision doesn't provide an impediment to innovation and that it actually encourages the banks to develop and implement sound digital transformation plans, especially if those plans make the banks more efficient, more cost-effective, increases their profitability, and creates a more sustainable business model for the sector. Now, having said that, I don't think it's fair today to compare banks to dinosaurs, since, of course, digital transformation is certainly underway across the euro area. But I do fear that many banks may be underestimating the speed of technological innovation and the urgency of transformation. We only have to look at the developments of digital transformation in the AI area in recent months. I don't think we'll be looking for eating glass in particular, but generative AI language models are demonstrating a potential to be a real game changer for many businesses. And while banks are already making changes, it is the nature, the speed, and the extent of their transformation that'll determine, in the end, how they manage their business models and their strategic risks, as well as their operational resilience. So last year, we launched two major initiatives at the ECB to deepen our understanding of the digital transformation of the European banking sector. We engaged with stakeholders, including banks, technology companies, consultants. We really wanted to gain a line of sight into the developments in the marketplace and understand the major market trends. And we also decided to survey the 105 banks to assess the status of their digital transformation, what's actually going on in the portfolio that we supervise. So I need to add a caveat here that the results of the survey are based on the self-assessments of the banks. We have not, as supervisors, assessed these. That'll be a next step that will take place in our process. So what did we discover? It won't surprise you, I don't think, to know that almost all of the banks that we surveyed now have a digital transformation strategy in place. It's seen as de rigueur. But perhaps more surprisingly, the strategies are not always fully developed, and they're often supported by only limited investment. The core focus of the bank strategies is, of course, to improve profitability, either by enhancing customer experience or improving their operational efficiencies. So on average, and these numbers I think are revealing, banks were allocated 5.2% of their staff to digital transformation projects. Many banks launched a variety of initiatives and projects, but these things are very multifaceted. And by their nature, it's difficult to get your arms around the entire picture. And in fact, we saw that banks struggle to isolate and to quantify the cost and the revenue impact of their digital transformation strategies. In addition, average budget tells us a lot. The budget that the banks are dedicating is quite limited. It's accounting for only 4% of their operational costs in 2021. Banks are reporting today that most of them have a coordinating body. That's a good thing. They have a management coordinating function that's in place to steer their digital strategy. Some of the executive and the supervisory bodies do include members that have some IT experience, but for sure the war for IT talent is very evident in the oversight structures within the banks. It's seen very much as a key challenge to them. Banks are reporting that half of their customers already appear to have gone digital, so they need to be in that space with them. On average, the surveyed banks were concluding 46% of their loans using digital channels, 36% of their customers were using mobile banking, and 21% were using online banking. So when it comes to how the banks are using technology, we also see a mixed picture in the survey results. Almost all of the banks are using some form of cloud and application programming, while 60% of them are using AI, and there are more use cases that are under development. Less than 20% of them are using distributed ledger technologies, and when we checked for crypto activities very specifically, given the concerns that we have about that marketplace, we found that these were actually insignificant for the surveyed banks. But I don't underestimate the threat and the need for guardrails here. Considering bank customers' heightened interest in investing in crypto assets, the topic definitely requires further attention. And we also have the question about interconnectedness in the overall marketplace. Where are there connection points between bank lending products and counterparty arrangements, which we need to make sure are transparent? Even yesterday, I noticed Silicon Valley Bank had a very big drop in its equity valuations, and that was due to its connection to the technology sector, but also a convergence of risk with the current high interest rate environment that we find ourselves in, and the ultimate mismatch that can occur in the asset liability management on a bank's balance sheet. So it's these convergence of risks and interconnectedness in the marketplace that I think we have to be particularly concerned about. So we also see that banks are relying more and more on outsourcing arrangements and external partnerships. And as they open up their infrastructure to outside parties, there are risks, of course, around third-party dependencies that we need to be paying very close attention to. There are concerns about money laundering, fraud, and cybersecurity. And the need to address gaps in internal technical skills and this war for talent contributes to an increased dependency on third parties. So there's an iterative process taking place in the banks. Banks are acknowledging these risks in the context of their digital transformation, but their risk appetite frameworks and their stress scenario analyses are not always reflecting these risks. So we need to change the mindset in how we look at those things. Digital transformation requires a holistic approach. If a bank is going to successfully implement a strategy, The individual operations, products, and processes are not the only areas that have to undergo change. It's really also a cultural change that has to take place. And anyone looking to embed technology into an institution knows very well this component about creating a cultural mindset around technology and digital transformation change. But that change should not only encompass the business strategy of the bank, it has to also cover the governance and the risk management frameworks. Supervisors have to be able to assess the business model of the banks and whether that bank has established an appropriate risk management and governance arrangement. The mindset of digital finance also has to be reflected in how they govern and how they manage their risk so that they can stay ahead of those risks. We put into our supervisory priorities for 2023 and 2025 our plans to work on digital transformation, and we will have targeted reviews that we'll be doing, and we'll be doing also on-site inspections that will be carried out later this year. In the targeted reviews, we'll be looking at governance, at technological and operational aspects, at the bank's overall strategies, and we'll also look at the impact that they have on the business model and the profitability. We'll be asking certain questions. How does the bank's internal governance framework support the development and execution implementation of the strategies? Are the bank's risk management frameworks equipped to deal with the potential rise in IT, cyber, and operational risks? How are banks managing their third-party risk? And do banks ensure adequate data quality and data aggregation for proper risk governance and sound risk-based decision-making, also for their digital transformation strategies? So we'll publish our findings, so you'll have a chance to have a look at that. And we do intend to have a particular focus on best practices, not just the deficiencies. We very much see that as our role, to be communicating what best practice looks like. Ultimately, these findings will make their way into our revisions to our supervisory methodologies, and maybe we'll be behind the curve a little bit on that, but we'll certainly be looking to catch up. So now let me just spend a minute on the broader challenges, and I think each of us has had in our interventions a focus on these challenges. For sure, the new frontier is bringing transformation across not only financial services, but transformation that needs to happen in the supervisory bodies, because the landscape is profoundly changing. As banking supervisors or overseers of the securities markets, we've become quite accustomed over the years to debating, the different regimes. Over the decades, we're using definitions of products, categorizations of delivery mechanisms, and categorizations of business models to help us decide how we assign oversight activities to appropriate regimes. But today, our challenge is even more pronounced as the digital transformation has blurred the lines. We don't have clear line of sight into where the borders are, because of course the borders are not as distinct as they are in the physical world. And the collapse of FTX last November has left us with questions about gaps in the framework. How can we achieve consolidated oversight of firms that claim to have no headquarters at all? What does that mean in terms of having a home country supervisor, banking supervisor in banking supervisory parlance, or an equivalency regime if we use the securities oversight arena and that parlance? The lack of a traditional central entry point poses challenges, big ones, for our current regulatory and supervisory approaches. And looking at the crypto market in particular, I'd like to see much more regulatory convergence and supervisory cooperation at the international level. I'm not sure that the structures that we currently have, IOSCO, Basel, FSB, are enough to support what needs to be done on the global level. Individual regulatory regimes based solely on individual jurisdictions, I believe, are no longer sufficient. The new developments in digital finance are really shining a spotlight on the need to have a more integrated global framework in place. And without it, we're just going to experience continued regulatory arbitrage. That'll increase the risk of customer losses, and that in turn will contribute to instability overall. It will threaten financial stability. So I'm proud that Europe is leading the way in developing regulation. That's a really great thing with the MiCA framework that's being put in place. It's highly welcome. It's really great progress. but on its own, it will not be sufficient to close all the potential gaps. And that's not least because the same level of oversight does not exist in most other major jurisdictions. And for as long as this is the case, I fear firms will continue to arbitrage around the globe, Bahamas, other places, and we know what the end of that story will look like. So I hope that we can end the arbitrage, of course, within the euro area, and that we have a lot of information exchange and cooperation since we recognize these gaps. And it's so great that you're doing this conference. So innovation has certainly been a constant presence in the history of banking. And whether it's a technological renaissance or revolution, I don't know. But the confluence of increased consumer demand, competitive pressures, and the really rapid and accelerating technological innovation makes digital transformation a real strategic imperative for the banks and also for the supervisors. But the digital transformation of banks is only one side of the coin. The banks have to also be adapting their governance, their risk management, and their overall steering capabilities accordingly. We need more convergence and cooperation at the international level, particularly with regard to crypto activities, and we ought to be able to do it. After all, it isn't the frontiers of outer space that we're looking to conquer. It's simply we're looking to manage the risks that are here on Earth. Thank you very much.
Elizabeth, many thanks for your deep thoughts and also for giving us the insights from the ECB, all the initiatives that you have been conducting, the evidence from the fact-finding that really provides us with additional insights. That is indeed very helpful and appreciated. I would also personally note and thank you for reminding Tommaso Padoa-Schioppa that among other functions, he also has been chair of CONSOB for a while before transitioning to ACB. So thanks for reminding his deep contributions on financial regulation and supervision. Now we move to Edward with another interesting topic that goes very much to the heart of any security regulator, that is digital finance and investor protection. Thanks, Edward.
First of all, let me thank you to CONSOB and especially to you, Caro, for organizing this conference and for giving me the opportunity to go with you through some of the major topics on digital finance and consumer protection. So I want to start with trying to find a definition, and maybe you can give me my slides, thank you, on what we are talking about when we are talking about digital finance. Then what do consumers actually need to be protected from? And of course, we are supervisors. How can we, as supervisors, protect consumers in an effective way from risks and harm? Digital finance is the term used to describe the impact of new technologies on the financial services industry. It includes, therefore, a variety of products, of applications, of processes, and as a result of business models that have transformed the traditional way of providing banking or other financial services. This sounds easy and also understandable, but the buzzword in this definition is transformation, because the digital transformation not only transforms financial products into new digital formats, but also creates new products, new services, and thus new business models. And as you can see on the slides, the product, of course, that also might be the same, banking service or whatever, insurance. But digitalization creates also new types of products. Token, the different forms of token, from utility, asset reference, move to earn token. That's what I learned in preparing for that conference. Fragmented shares, of course, we had it also in former times, or instant payment. But by using different processes behind the application, a lot of new business models like trading platforms, wallet providers, robo-advice are penetrating the financial markets, and also new participants on the market like fintechs and big techs, they are now in competition with the established one. However, to sum up, complexity is increasing and consumer protection is becoming even more and more challenging. If I now try to compare the complex economic landscape of digital finance with the map of legal access, John presented it very well, two things stand out. First, the digital finance package is comprehensive, but the dynamics of technological developments show that not all digital financial products or services are already covered by the new regulation. Decentralized finance, it was mentioned by several other speakers, is maybe the most important example, but we also heard today about autonomous finance, and that might be the next one. So if I would comment it a little bit in a critical way, I would say, okay, it's a comprehensive regulation, but maybe less and late. Second, we all agree to the principle, same products, same services, same risks, same rules, and same supervision. But I doubt if we are always able to determine if we are talking about the same product, if we are able to compare, or maybe if digitalization per se creates something different. So in theory, this might work, this principle. In practice, I have my concerns. Nevertheless, the level playing field regarding authorization or the legal base for comprehensive supervision are very much appreciated. And the new regulation addresses relevant aspects also of consumer protection. MiCA aims to support innovation in the industry and improve consumer and investor protection by establishing safeguards against common financial risks and preventing abusive and misleading market practices that disturb fair competition and that might erode the integrity also of financial markets. And of course, DORA, with regulations regarding governance, risk treatment, IT security, business continuity, employee training, and so on. This is, from my point of view, maybe the most powerful instrument also for collective consumer protection. But we, as supervisors, we need to address these new supervisory responsibilities. We need to address these new challenges in recruiting and training of our staff, as well as investing in our own ICT tools. The keywords here are capacity building, regulatory technology, supervisory technology. I really love ChatGPT. Not only because it empowers me to support my daughter when doing their exercises, or supporting her with writing a love poem, whatever. But I also used it to prepare for my presentation here, and I asked ChatGPT how artificial intelligence can be used by supervisors to protect consumers from abuse of artificial intelligence. And I got a really impressive and comprehensive answer. First, ChatGPT told me financial supervisors can use AI to develop regulations and standards that guide the use of AI in the financial sector. These regulations and standards can protect consumers from abuse of AI by ensuring that AI systems are transparent, fair, and accountable. Second, Financial supervisors can use AI to conduct audits and inspections of financial institutions that use AI. Third, financial supervisors can use AI to blah, 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 identify any patterns or trends that may indicate abuse of AI by financial institutions. Fourth, AI can help identify patterns or trends in complaints which can be used to identify potential issues with AI systems. And last one, financial supervisors can use AI to develop educational materials for consumers that explain how AI is used. So I really was impressed. Artificial intelligence is, it looks like, able to solve the problem it created itself. So now I also understand why very often artificial intelligence and business intelligence is used in a very similar way, because it looks like to be also a very a business model for the future. Later on I will talk where we are using artificial intelligence for our supervisory matters in the Austrian FMA. On this slide you see another example, but not on based on AI, but on the Artificial Intelligence Act. So I know we have time, but we try to prepare for it. You see it on insurance supervision. We will start with a sample-based check in our insurance companies on health and life insurance, and we will try to find out if there are some non-compliance matters relying on Article 17 IDD, for example, because of customers' low propensity to shop around, the so-called low probability of churn, of customers' low price elasticity, and of the way of nudging consumers to buy one insurance product versus another because of a very low initial onboarding price. We should be aware that sometimes, especially we as supervisors, we always think that we know what our job is, but we should be aware of what consumers should be protected from. From my point of view, first risk is the hidden disadvantage and the discrimination. Digital finance companies may use algorithms or other tools, decision-making tools that result in discriminatory outcomes, such as denying credit or insurance based on factors like race or gender. Second, misinformation and non-compliance. This means misleading marketing practices and lack of transparency. Third, unfair pricing and contract terms that limit consumers' rights or allow the company to change the terms of the contract without notice or consent. Fourth, cybersecurity risks, personal and financial information. I think that's the most important thing, and it's a vulnerable thing, especially to cyber attacks in digital finance. This can lead to identity theft, to financial fraud, or other types of financial losses. And of course, fraud, especially as one of the learnings of the COVID crisis, with more and more digital tools used also in the whole population. Financial fraud was increasing in a dramatic way. But now, how to prevent? We as financial supervisors, we have a range of instruments we can use in protecting consumers. But on the other hand, we have limited resources, and with an eye on these limited resources, we only will succeed if we use our instruments depending on the compliance behavior of market participants. This is the so-called model of responsive regulation or responsive supervision. I can give you some examples. I don't want to go through the whole pyramid, starting with empowering consumers and going up to using the full power of law with sanctions and with the withdrawal of licenses. We as supervisors, we can empower consumers through education, through awareness campaigns, and help them to make informed decisions. This includes, of course, financial literacy in general, as well as providing specific information about risks and also, of course, benefits of various products and services. Second, we can use soft law instruments, such as guidelines, recommendations, best practices, to encourage financial institutions to adopt good governance practices. Third, we can conduct on-site inspections, so the traditional way of supervision, off-site supervision, to ensure that financial institutions are complying with regulatory requirements and that they are effectively managing the risks. And fourth, at the end, at the top of the pyramid, sanctions and enforcement. It's needed. We all know that it's needed, especially if we have to fight against fraud. In Austria, we only have a mandate on collective consumer protection, not on individual. So therefore, I have to focus on my own experience. But nevertheless, also with the limit of the mandate to collective consumer protection, we have an eye on enabling personal responsibility of market participants. And let me therefore point out three main aspects of collective consumer protection as far as I see it. We are, as FMA in Austria, part of the National Financial Education Strategy. This covers all areas of life, from kindergarten to retirement. For example, only to give you a few examples, we as FMA, we are providing various information, of course, on the website, as all our supervisors do. We are cooperating with media in our so-called Let's Talk About Money series, and we just right now are starting to support in Vienna as a pilot secondary schools in financial education. Second, we ensure compliance with regulatory law and with soft law along the pyramid presented above. So we make sure that transparency and information obligations are met, and in this way of doing our business, we also rely, of course, on new technologies, for example, using a web crawler regarding BRIPS-KIT. And third, we address complaint management in financial institutions as one of our supervisory priorities in off and as well on-site visits and in our so-called management talks. I know from some other NCAs, we've also a mandate in individual consumer protection, that they are working, for example, we also discussed it in ESMA with mystery shopping, with providing mediation or arbitration services in Austria, so this is not in our responsibility. And to come to an end, I would like to show you our consumer and consumer compliant inquiry database. We launched this database in January this year, and we also use artificial intelligence to categorize and to evaluate these complaints. And we use this database, for example, to prepare our on-site visits, to make our risk management. We use it for market monitoring or for product intervention, and of course for trending our consumer information. And also for me as a manager, it's very important to have all these figures just in time, so as a dashboard on my iPad. And to conclude, because the main theme is the new frontiers of digital finance, so maybe the new frontiers will not be easy to build, because as also Carmine said in his presentation, it's the inherent definition of digital finance in the World Wide Web that more or less no frontiers do exist. So maybe we need to agree on not only national, not only European, but worldwide rules of game. Thank you so much.
Thank you, Edward. In presenting you, I declared how much we are aligned in terms of addressing same challenges or common challenges, and let's say have some sort of parallel discussion. I recognize, let's say, where you are and where we are, and the ambition of moving ahead, at least in terms of our supervisory responsibilities, say as fast as possible to embrace the technology, and of course the insights on the consumer, you said collective consumers, let's say, approaches and risks are very inspiring and very well noted. Thanks again. Now, moving to last, but as we say, really not least speaker, Paolo will bring us into more something that is also very much in the heart of our attention and Capital Markets Authority of digital finance and market infrastructures. Thanks, Paolo.
So thank you, Carlo. Let me first of all be the last one to thank President Savona and Council for inviting me today. I'm really happy to be here and be part of this very interesting panel. So the topic I was assigned was the topic of technological innovation in payments, securities, clearing and settlement system. That is the market infrastructure that is the backbone of our financial system. Another term that has been sometimes used is the plumbing, as Carmine Di Noia mentioned. So just to be a bit provocative, let me argue that this is probably the sector that has been least affected thus far by the latest technological developments that inspire today's seminar. And by my emphasis is on latest, because I think we all have in mind DLTs, big techs, and the rest. So the reason why I'm saying this is that a lot really has happened in the realm of the plumbing over the last decades. The adoption of digital technologies for financial market infrastructure started in the 60s with the dematerialization of securities. Trading on digital platforms began to replace trading floors, the so-called pits, in the 80s. In the 90s, the real-time gross settlement revolution struck the market, and that revolution brought added securities to market transaction at affordable cost. We should remember that what was made possible by RTGS was a huge increase in the velocity of circulation of money, of central bank money, that made real-time settlement, final settlement, possible at affordable cost. And since Tommaso Padoa-Schioppa was mentioned before, let me also mention that among the many things he did when I met him, when I joined the Bank of Italy in the early 90s, was pushing the Italian banking system toward RTGS, and he was successful. Then the next step was to eliminate counterparty risk in securities transaction via the adoption of the so-called delivery versus payment. Then came algorithmic and high-frequency trading that in Europe now accounts for about 70% of all equity trades. Nowadays, almost all financial assets are in digital forms and are traded through electronic platforms. All wholesale payments are initiated and settled online. In Europe, just as an example, we have the system, the RTGS called Target2, which on average settles about 2.5 trillion euros worth of transactions each day. That is about 1/6 of the Euro area's annual GDP. Target2 interacts with Target2 Securities, which is basically a platform which does allow DVP of the cash leg and of the security leg of many transactions, with eliminating counterparty risk. So I would argue that as far as market infrastructure is concerned, this digital revolution has already, to a large extent, silently happened. But this said, the innovation pipeline is by no means empty. So I will review a couple of 2-3 recent developments of this traditional flavor, and then conclude with some remarks on the debate about the DLT technology and its impact, real or potential, on the plumbing. Among the recent development, many actually concern, again, the RTGS world. In 2018, the Eurosystem launched the so-called TIPS, the Target Instant Payment Settlement. It's a new mechanism which is conceptually fairly similar to Target, but it enables participating banks and their clients to transfer funds within seconds, 24/7. The Eurosystem at present charges banks for the use of TIPS well below 1 cent per transaction. So we're talking about here the real efficiency, and the Eurosystem it employs a cost recovery principle. The Swedish central bank is joining the system with the Swedish krona, and talks are ongoing with other central banks to join the system. Another important example is the consolidation of Target 2 and Target 2 securities, which is expected to go live. Actually, it will go live 10 days from now. Nothing revolutionary, but the thing features a centralized liquidity management framework, which will make liquidity management even more efficient compared to the Target and Target 2 securities, which we have now. So still a further increase in the velocity of circulation of central bank money. And third example is the creation of Eurosystem collateral management system. Again, nothing revolutionary. The collateral management for the Eurosystem has been in place since 1999, when the euro was launched, but this new system will be interfaced with Target 2 and Target 2 securities, and it will basically create a seamless infrastructure across the euro area for the efficient management of collateral. So a lot, again, as I said, has already happened. Has this machinery reached its full potential? Can it be improved further? As we've heard today, much of the debate is on the DLT and on blockchains and on other key technological developments. I will leave aside the crypto market, which is a big can of worm. Some remarks have already been made on this, and I will stick to my assignment, that is DLT and the plumbing. And concerning this issue, what can DLT do for the plumbing? I guess one can summarize the views in two main types of claim. I would argue that some of the early hour proponents of DLTs, which are sometimes called the true believers, argue that this technology, the DLT, has the potential to do away with financial intermediaries and their trust-building role. It's just a matter of the technology, the fact that the ledger has a distributed nature, the fact that it is impossible, quote unquote, for every single user to tamper with the record once the record is validated, can pave the way, really, if not to a complete disappearance of intermediaries, to a diminished role for intermediaries. Then there is another view, not really alternative, it's possibly a complementary view that holds that DLTs can boost the efficiency of the system. Why? Because of the reason we've heard from some of the panelists before. It's a useful new tool, basically, that can be put to use to improve the system. In this case, the emphasis is not so much on the DLT governance, as much as on the benefit that can stem from the technology, independently of whether the technology is assigned to an intermediary or not. So let me express some skepticism on the former view, on the true believer view. One way or another, that's my gut feeling, counterparty risk would find its way into a fully decentralized, large-scale trading and settlement system, because in the end, these systems, in order to be scaled up, need some form of central infrastructure. For instance, exchanges are needed for the storage of tokens, for the storage of cryptographic keys, for trade, for conversion into other tokens, etc. This is something that has been efficiently summarized by Carmine Di Noia with the DINO, the decentralized in name only acronym. Of course, several episodes that we all know have shown that this infrastructure is very prone to traditional risks. Cyber and fraud risk come to mind. So when one realizes that this is the case, I think DeFi loses much of its appeal, at least as far as the plumbing type of usage is concerned. So the second view holds that DLT is a useful tool, and I will not, argue with this. It's been forcefully argued that DLT is here to stay, and I, tend to agree with this. It depends on where it's going to stay. But it is undisputable that DLTs have useful features. Market participants are really abuzz with this. Let me just mention that we, in December, issued a call for interest, call for proposals from the market using our Milano Hub, which is the innovation center that the Bank of Italy created to support the digital evolution of the Italian financial system. And we got 57 projects that were submitted by about 87 participants, many Italian, but also coming from abroad, many international parts. So the issue here is an empirical one, and that can be summarized in a couple of questions. Is large-scale DLT adoption in financial market infrastructure feasible? And if so, do the advantages outweigh the cost? It's just a matter of running a cost-benefit analysis. And I think these are important questions which provide, I think, a strong motivation for central banks' interest in the topic. And actually, in his opening remarks, President Savona mentioned a speech by Carstens, the BS manager, that really makes this point. Central banks are interested in this topic because I think their action, that's my argument, and I think Carsten's argument as well, is some sort of a prerequisite for the DLT to fly within this environment. Let me be more clear about this. Without adequate solution for the DVP settlement in central bank money of token traded on the DLT, the latter, the trades that take place on private DLT could never achieve the level of safety that is typical of traditional settlement. It's the issue of DVP in central bank money that I was referring to before. We have Target 2 today, but Target 2 without some adjustment would be unable to deliver DVP and to simultaneously settle transactions happening on the DLT, on a private DLT. So today what we have is a flurry of experimentation, of even projects that go already beyond the experimentation stage, and this is happening among regulated financial intermediaries that are issuing securities, tokenized securities of the traditional type in token form, and they are successfully settling these transactions in DVP using tokenized commercial bank money. This is all very interesting, and it allows us to get a glimpse of what the potential of the technology is. But again, I think that settlement in central bank money, when you go to a large-scale type of mechanism, is no longer optional. For the reason that I mentioned before. I mean, going back to settlement of a large part of the plumbing in commercial banks' money would bring us back to the 70s with, the incidence of large, potentially large counterparty risks. Some of you may have in mind the Herstatt case, which gave rise to the growth and the development of RTGS in the 70s. So that's the reason why the central banking community is really working hard on the issue of a wholesale CBDC, and that is meant to be a tool to settle trades happening on private DLTs, and which is to be kept quite separate from the CBDC that we read so often in the press, which is the retail CBDC. So this wholesale CBDC is a sort of a precondition, as I have argued, for a safe, widespread adoption of DLT in market infrastructure. The Eurosystem at present is exploring two main models. It is a fairly complex discussion, very technical, that frankly goes above my head, but the two models are basically, in a nutshell, are the following. One tries to create a CBDC the tokenized version of CBDC, which goes hand in hand with the private version of the DLT. And the other one tries to leverage on target, on the standard mechanism, in order to avoid the fragmentation of liquidity. And let me express some preference for the second option, simply because I have a conflict of interest. The Bank of Italy has been working on this, so we published last year a paper that documents the successful implementation of this mechanism at an experimental level. I refer those of you who are interested to our internet website. But again, this is very much happening at the moment. So let me come to a conclusion. I think that concerning large-scale DLT adoption for financial market infrastructure, the jury is still out, I would argue. The DVP settlement in central bank money, as I have just argued, is in the hands of central banks, and this is work in progress. We're working on it, but we're far from being done. There is, furthermore, a lack of solid evidence about the actual benefits of DLT adoption for this infrastructure. Actually, some of you may know about a prominent project to move a securities exchange to the DLT technology that was attempted in Australia by the Australian Securities Exchange. And this project, after 7 years of work and the sunk cost of about 250 million euros, was basically put on hold indefinitely. So there are reasons to be careful. At the same time, as I have argued and as you have heard from my fellow panelists, the market interest is there, no doubt, and the technology does have a lot of promise. One possible reason why we haven't seen enough in terms of DLT adoption in the plumbing concern legal uncertainty. And here I refer to the DLT pilot regime that has been mentioned by Sean Berrigan, by other panelists. We are, the Bank of Italy and the Consob and the Ministry of Finance are actively cooperating in order to finalize this project. And this is, if this is a hurdle, I think it's going to be eliminated quite soon. Thanks a lot.
Thank you, Paolo. You brought us to the roots of the operations, and we already mentioned that, say, without the plumbing, the financial sector per se will not work. So it's important to understand how these could be affected. You also mentioned some a word of caution, and we heard very loudly. You also mentioned your words, strong motivation by central banks. Clearly, let me say that, so still in the words of Professor Savona, but clearly this is an area of strong interplay and intersection where between central banks and capital markets authority we need to come up with, let's say, more clarity. And by no means, by all nature of this activity is not a national topic. It's more on a global scale that that would need to be sorted out. But thanks for reminding, let's say, these issue as well. Now that comes to, that brings us to the end of the interventions. I would like now to open the floor for the debate, starting with Paolo Ciocca. I already introduced him, and then prepare for, let's say, questions to have. And I would also ask here the panelists, the speakers, let's say, to think of the interventions to cross-cut on what we heard. First, Paolo, please.
Carlo, thank you. Thank you, Verena, and all of you to be here at Consob. Here now in a style of a quick, I hope, and bumpy ride in a Telegram-style Gliederung to stay on the approach. I'll try to give some quick notes from an NCA perspective. I'll cover three main points. A forward for context. What is the issue at stake? What can we do? Or better, what we can do. Let me start with the first one. Forward, where are we? Our context, which is a given. I will not go back to what we have already seen before. We know the market trends. The new norm is cloud computing with data analysis and appliances. This brings new business models in capital markets, which means rapid deployment of AI and machine learning systems, ICT dependence and fragmentation of the value chain, platformization of finance and data economy. The business model is based on a two-sided network externalities, platforms performing an intermediary function on one hand. The more participants, the greater the value creation. These centralized platforms coexist with the decentralized platforms thanks to blockchain and the centralized finance. What does it mean? From the supply side, we have new types of complex, bundled, client-specific service and products. On the demand side, we have, I would say, new average investor, less readable through traditional economic fundamentals because of, for example, the use of AI, machine learning in trading algorithm and market sentiment analysis. On the other hand, a recent study proved this, gamification with no value rewards, thin influence and the like. This same new average investor, motivated by non-financial purposes, for example, sustainability, connected through social media, which means capable of coordinating and build a campaign. Remember GameStop, accustomed to not to pay for services, and I would say this having in mind, as Ronnie said before, keep in mind the path to open finance. If this is the context, let me say what is the issue that is at stake for me. And again, I take one of Ronnie's point before. I believe that all in all, we regulators, legislators, co-legislators, and all of us, are confronted with the challenge of shaping a new concept of trust. Investors, operators, shareholders, stakeholders, the public in general demand, in my view, an augmented trust. I'll briefly expand on this. Whilst traditional trust, which means issuers' solvability, reflected in market prices and transparency, was mainly based on quantitative data, think of financial information, which brings with itself 50 years of harmonization of, for example, accounting and audit standards and the like. This is no longer enough. Beyond the solvability, transparency, augmented trust implies also sustainability, trust, tech reliability, security to start with. And I don't think this is a closed list. But this augmented trust is also more vulnerable. It is more vulnerable at least for 6 factors. A tech element, just to list bugs and unexpected outcomes from algorithm, biased and unreliable AI, I will not dwell on this, it has been already covered, blockchain, pseudonymity, opaque governance, and other, let's say, related enforcement challenges. Second, non-quantitative analysis, but qualitative elements, for example, in assessing sustainability without any or long-standing standards. Third, security elements, cyber resilience, but also data integrity. Fourth, challenges in protecting data privacy and risk of personal data exploitation. Fifth, different informational challenges. And here the point is that non-quantitative information is easier to exploit for ordinary information asymmetries, but also for manipulation by malicious actors, and I think of individuals, corporations, and also state actors. Sixth, and last, market concentration, lack of competition, and this means incumbents suffer several legacy issues. Use of AI and ML and big data require major investments, digital platform, strong externalities leading to winner takes all or winner takes most situations. Infine, I would say these augmented trust vulnerabilities do apply not only to intermediaries, but even more to critical infrastructures like market operators. I come to my third point. What can we do? Or better, what we can do. I would say some notes for the present and for the future, and here I would say caveat, regulator, or Warnung, Aufsicht. I would think we should be aware that all recipes do no longer work. I take just one example, I had 2 and I skipped the second. But the first one, and maybe the easiest to recognize, inducements. Current distribution models and inducements are destined to be superseded by platformization and data economy. Why? We have new generations of investors accustomed to quoted and unquoted services, not willing to pay for trading or advice. We know that there is no free lunch. Still, they simply prefer to give up their data. Intermediation applies at a different and less transparent, maybe hidden at times, level. Think of payment for order flow. This implies that incumbents are no longer able to rely on traditional economic rents, given the increasing competitive pressure from tech companies and platforms. So my personal take on this would say better to change before it is too late. Let me come, and this will be my final point, on some actions, let's say proactive cost-ruins actions, and I've listed 8. First, on technology, I think that technology has a crucial role in delivering an augmented trust, made of transparency and security. For example, fully exploiting the potential of DLT, AI, IoT for financial supervision, audit and compliance, fostering automatic embedded compliance, programming regulatory requirements in the code of algorithm to decide upfront compliant smart contracts. Employing AI in risk management and identification of flaws in the code of the smart contract, so reverse engineering for this purpose. Second, I would say avoid winner-takes-all situations by supporting new market entries, including decentralized platforms. Leaving, let's say, decentralized finance to others would be, in my view, a mistake, but ça va sans dire in a regulated framework, and I underline this. Pursue platform interoperability and regulatory interventions to help closed-loop systems, build new, let's say, open finance, take into account that fintech companies at the start do not possess large networks, customer bases, or funds, and may be taken over by bigger, let's say, bigger actors. Third, simplify the institutional architecture and foster cooperation. I would say focus more on the interaction between vertical and horizontal frameworks. Think of GDPR, AI regulation, Data Act, Digital Market Act, to name one. Strengthening cross-sectoral cooperation at an international level. This has been recalled both by Carmine, Verena, and John. Fourth, modernize a regulatory framework to bridge the gap within other and more developed and attractive capital markets beyond the EU. I will not go back on CMU. We know the discussion is ongoing. We have seen recent important and let's say, announcement. I would say what we need to do in parallel is that we need to, let's say, in parallel, revisit CMU in light of the digital transformation. I will not go through, I leave it to my text. Fifth, adapt the single rulebook to enable easy compliance in the digital space. This means, for sure, leverage on sandboxes, promoting an open dialogue with market participants, endorse a more, let's say, activity outcome-based functional approach, look at the policy objectives of the rules and allow for their implementation achievements in innovative ways. Thinking of MiCAR, for example, how to adapt governance rules to decentralized autonomous to DAOs, how to apply custody and segregation protections to the crypto space, what triggers crypto market abuses, to what extent, for example, the practice of miners' extractable value is legitimate. On the other hand, MiCAR, I believe, is capable to capture, to some extent, DeFi and also global platform. If we apply rules ensuring that substance prevails over form, and we remind to ourselves that reverse solicitation is an exception, so this must be interpreted in strict terms. In general, our big challenge remains maintaining an open mind without, however, being captured by the fear of missing out ourselves. Sixth, and I'll move quickly to the end, move quickly towards more convergent supervision and enforcement of the internal market, and here our support to ESMA's role in importance here just underlying common understanding of EU rules, convergence in day-to-day practice and preventions of arbitrage, no options and discretions, underline, data-driven supervision, raising awareness, let's say, in this I recognize the fundamental role of ESMA. Last 2 points and I'm finished. Financial education. I think that here too current patterns are no longer viable. With new generations entering the investment cycle, we need to adapt to their media, social media, and which means then simplified and clear message. And here again I welcome ESMA Effective's effective warning campaigns in this vein, and I think this is an example to be followed at national level. Last, I'm finished, but not least, I would say maybe this is the most delicate point, it's for sure for a national authority, but I fear not only. Resources, financial and human, are, I would say, at least constrained, if not strained, to all of us. And in particular, we all have difficulty, and I would say, to be more frankly, we have no goal in accessing skilled and diverse STEM resources, given the competition by big tech in this segment. I frankly do not see possibility of a change in this situation without a major change of pattern. So my impression is that we need a pooling of resources, pooling of human resources at both national and EU level. An example and a proposal. What about an ESMA or ESAS Innovation Academy devoted to research and training, financed, for example, by in-kind national personnel contributions, short term, on a private-public partnership model with industry and academia? Question mark. I think here ESMA could play a major role in pooling knowledge for the active engagement of NCAs for the benefit of the EU financial ecosystem. I think I would say ready to help out, as I think you say in German, pronto. Thank you for your attention. Thank you.
Thank you, Paolo. Now, before turning to the conclusions by Professor Italiano, I know that there are at least a couple of brief interventions. Do you have a mic that we can give? Probably we can start with Professor Medda, who is over there. Where is, yes, Professor Medda, yes, please. He's not, you're not planning, okay, I thought you were. Okay, that Professor Annunziata is over there.
Thank you to Consob for setting up this very...
Professor Annunziata, Bocconi University, sorry.
Yes, sorry, Bocconi University, yes. So thank you again to Consob for setting up this amazing conference. I would like to set out a request. Can we stay here for the entire week? Because there are so many things to discuss that squeezing all of this into 3 hours is quite challenging. But I have 3 points that I would like to raise and maybe address some questions. I leave it up to Carlo to, guide these questions eventually and to direct them to the proper panelists. The first concerns MiCA and the digital euro. And these are 2 great work sites that are going on parallelly. They seem to be not interconnected. Actually, the MiCA draft is quite clear on that because it excludes digital euro from its scope. But my question is, shouldn't we look at enhancing the interconnections, interoperability, and these 2 work sites ultimately should more or less dialogue one with each other. For instance, when stablecoins use the digital currency for their reserves, or when you look at transactions on a DLT settlement on DLT platforms that you can settle either through digital euro or through a private payment token such as an ART. That's the first problem. Let's try and understand whether we do need this kind of enhanced, let's say, connection between these 2 work sites that, as of today, seem to proceed on parallel levels. And this also touches upon institutional aspects, because the landscape that we have in MiCA, if we look at the payments token part of MiCA, is quite interesting, because we have non-significant ARTs and DMTs issuers that are supervised by NCAs, but then we have the significant ones that instead will be supervised by the EBA. This is quite interesting because the EBA is sort of transforming itself into a supervisor, and it's sort of following the path of ESMA that has already undergone this partial transformation some years ago. But then we have the digital euro, which is under another kind of supervision because it's the digital euro, so that's the ECB. And my question is, will this system work properly? Because before even we consider international cooperation, we have to probably think whether the structure of supervision on the digital payment, public and private side, will work properly in this three-tier system: NCAs, EBA, and ECB. The second point touches upon taxonomy. MiCA is quite clear again. The scope of MiCA does not include anything that is already regulated by existing financial legislation, including naturally financial instruments and MiFID. Everything seems to be clear enough, but we know that we have a lot of uncertainties in really understanding and framing what a financial instrument is under the current MiFID landscape. And this is a long-standing issue. The position paper, the opinion that ESMA provided in 2019 to the European Commission on crypto assets is quite interesting in this respect. But my impression is that probably we have to accelerate in understanding taxonomy better, otherwise we won't really know what falls into MiCA and what doesn't fall into MiCA because it is already captured by MiFID. I know it's a very hard exercise because it's highly reliant on national legislation, on national interpretation, but I think it's a fundamental task we have to carry out. Also considering that in certain member states, we have additional notions that might impact on MiCA and might create fragmentation in the market, such as Italy, where we have the financial product, the prodotto finanziario notion, which is quite unique. Probably you have something like that in other countries, such as in Austria, but this is a potential danger for MiCA in terms of fragmenting markets if we don't really touch upon this issue. The last point is MiCA is marketing crypto assets regulation. And my question is, where are these assets? Where are these assets? I know it's provocative, but most member states are lagging behind in regulating tokenization of shares, bonds, financial instruments. Some are moving ahead, some have already introduced national legislation, but this legislation is different from one country to the other. I know this is out of the scope of MiCA, but my question is, are we sort of running too far in relation to legislative and market developments in terms of tokenization? For instance, in Italy, we still haven't introduced rules on tokenization of assets. And we're thinking about it, but in Luxembourg or in Germany or in France, they are quite ahead. But the rules that govern tokenization are different because they depend from national law. And this is another potential danger in terms of market fragmentation when this, what I judge, great achievement of MiCA, really great achievement, and it's been done very fast. I think that less than 2 years, more or less, a little bit more than 2 years from the first proposal is very quick, considering also that we had the pandemic in between. So a great achievement, outstanding achievement that shows that the European Union, when it wants to do something, it can do it and not lose 30 years as we lost with the takeover directive in that respect. But also, probably we have to be careful because it could be just an intermediate step and risks of market fragmentation are sort of lurking in the dark and we have to look at them very carefully. So thank you again.
Thank you, Professor Annunziata. I look around here at the speakers, whether on the basis of the further contribution in the debate and whether there is any, say, appetite to raise our points, knowing that we don't have 3 weeks, not even 3 days, not even 3 hours. We have probably 3 minutes before handover for the conclusion. I look around whether there is any, say, Verena, you want to say a few words?
I wanted to just come briefly back on what the professor said, and I think the issue of definitional clarity is clearly a big issue, and particularly when you end up talking about definitions and boundary lines which are ultimately defined in national legislation very often, and also not necessarily only by those who are dealing with financial services, but actually with things that are much broader. So it's one of the tricky issues, but I think where we just need to pragmatically try to find ways to cooperate as securities regulators in ESMA, even when our underlying definitions might not all be the same, but we need to pragmatically see what's the effect, what's the actual business that is taking place, and how can we, within our respective possibilities, then deal with that. And I think MiCA is a big step forward, because at least where it's not a financial instrument, it is captured under a European framework. So I think that's already a big step forward. I wanted to very briefly just re-emphasize 2 points which have been made by others, and that is the capacity building and the scale and the skills that we need in future as supervisors and regulators in this field to really keep up with what's going on. And linked to that also the jurisdictional and timeline issues. We are passing new regulation takes time, and even if MiCA was done at record time, it's not quick enough to pick up all the developments. And the point that Elizabeth and others said about the jurisdictional issues, because we can't regulate this space in our old traditional way of looking at where responsibilities lie. Thank you.
Thank you, Verena. Carmine, 2 seconds.
Yes. No, just one comment. Also, was I listened very carefully to Paolo Angelini. Because we're here, I have to say that, I mean, we have seen in these last years, markets and financial markets developed when we had centralization. And the centralization in the exchanges, limit order book, in CCPs, the plumbing, the payment system, and so on. So why then, maybe DeFi is a sort of also of reaction, because decentralization, also due to economies of scale, scope, natural monopolies, maybe has been, accompanied by consistent profitability of some of the market infrastructures. And so maybe there could be also competition issues there. And so that's why there is some enthusiasm, and Paolo Ciocca also mentioned some what we have seen also in the last months or years in the market, or these maybe even young crowds, they think that something is free, maybe it's not, there is no free. So I think we should be still careful, and again, it's for you supervisors at the international and national level to also to find and to strike the right balance.
Thank you, Carmine. Now, thanks again to all of you. I think now is the time to hear from another voice outside the court. Professor Italiano is full professor of computer science here in Rome at the LUISS University. And please help us understand what we have been saying and what we need to look at for the future. Thanks.
Good morning. First of all, thank you so much for having me here. I'm delighted, and I feel a bit intimidated after this parterre de roi, and I'm also a computer scientist, so it's kind of not really a specialist in the area, but I took some notes, and I will go quickly through them. I think one agreement is that we live in a very complicated world, a very complex world. I think we all agree with this. And part of this complication is because of this digital revolution. I will call it revolution. I live in a city of Renaissance, so I wouldn't call it digital Renaissance. I would just call it digital revolution. And this digital revolution has many features. Let me just mention 2 of those features that were discussed by many panelists. One is disintermediation. So, digital technologies are removing several layers of intermediaries, and they can make markets and service cheaper, more accessible, and in some cases even more transparent to the end customers. Just to cite a few examples, Amazon has managed to disintermediate an entire supply chain. Airbnb the hospitality sector, Netflix, entertainment. Of course, they are not decentralized, right? They're pretty much central entities, central organizations. I mean, if we think about this, then in this framework, we should think about blockchain. We should think about DLT. We should think about big tech companies. I think Verena mentioned this, providing financial services. They have a lot of data. They know us much better than financial institutions. Some big tech companies started with, their stable coins already several years ago, and we're talking about the future. This is already the past. I mean, their stable coins did not work properly. Or some sort of platformization of finance. I think this is what Paolo Ciocca was talking about. And Ronnie was talking about banking as a service. I mean, this is really scary to me, because the question is, I was like exchanging few, interactions with Paolo Ciocca. I mean, if we go really through banking as a service, what will be the banks that will survive this? I mean, will be, I think, a big revolution, a big impact. The other amazing feature of digital revolution, and it was mentioned, I think, by Elizabeth, if I remember correctly, is the speed of this revolution. Let me just give you a short example. Cars took 62 years to reach 50 million users. As human beings, we had 62 years to understand what's good, what's bad, what we can regulate about cars, and many other things. And cars change our planet. Before cars, we did not have paved roads, right? We paved all our roads, change the structure of society, because once families own cars, then they could move outside of cities, and the whole thing changed, right? We cited, many of us cited ChatGPT. I mean, it's not possible to talk today in an event without mentioning ChatGPT. This I fully understand. So I think Verena, Elizabeth, Ronnie mentioned. You know how much time took ChatGPT to reach 50 million users? A little bit over than a month. So in a month, can we understand what's going on? Can we even thinking at this speed to follow up with some regulations? I mean, we have to be used to these things, and things are getting worse and worse as we go on, right? So this speed is unprecedented, I think, in human history, and it's really creating deep tensions between innovation and regulation. And let me just say, even between innovation and understanding even the phenomena, right? Because in 1 month there is not much you can understand. And I fully agree with Paolo Ciocca, right? I was born in an analogic world. Then I'm a computer scientist, so I became fully digital. So when I hear about a transaction, a single transaction of 161,000 bitcoins that was done on April 12, at the time was around $1 billion. It was carried out by the Bitfinex crypto exchange, was settled in 10 minutes, and the transaction fee was 68 cents. So when I hear this, I can understand what's the difference between a transaction in a financial institution and a transaction on a Bitcoin network. But then let's ask this question: what about the next generation? Will they understand this difference? I mean, they are used to have free things. They are used not to understand that they are paying these free things in other ways, right? And that's, I think, it's something we should also think about. So as Sean was mentioning, we are kind of moving from open banking to open finance framework. I mean, that's a big revolution. And we talk a lot about the EU agenda and all the regulations in place. This is great. This is amazing, right? But again, do we really feel safe in such a framework? The framework is evolving at a very slow speed, right? It takes a couple of years before something becomes a regulation. And technology is moving really very fast. So it's like what will happen in the near future. That's something amazing. And risks, right? Everybody was talking about risks. I think Carmine had a very nice slides about all the possible risks. Verena mentioned cyber risks, which are also important, right? As our life is more and more digital, and we understood this with COVID, right? As we were exposing more digital surface, then the cyber risk was much higher, right? And in the financial service, this is really problematic, right? We cannot afford to, not to think about those risks. And of course, we want to learn also from the crypto winter that was mentioned by many colleagues here, and it was a big shock for many people, but there was this implosion of Terra, Celsius, FTX, and I think Carmine also mentioned this. This is basically show a vastly interconnected ecosystem that probably people didn't think about before, but it was there, but it was more clear. If we don't understand the risks, if we have this FOMO, fear of missing out opportunities, we are just increasing the risk exposure and slowing down regulations, which is already slow by definition, right? So we are making things even worse. And this regulation is really becoming more and more complicated in different jurisdictions. I think it's very important to understand, as many mentioned, that it cannot be a local jurisdiction. These things cannot be solved by local jurisdiction. So we need to be able to cooperate internationally. And just trying to conclude, because I understand I'm the last thing between you and the lunch. There is no doubt that this digital revolution is pushing a growing demand for a new finance. And we are, we don't go back, right? That's where we are going. I think Ronnie was mentioning, there is a huge demand of improved customer experience and ease of doing business. And this will be more and more clear, with new generations. When I was young, generations were 25 years. Now generations are just a couple of years, right? So it's not a long horizon. I fear that if this demand is not met by official institutions, it will be intercepted and capitalized by other organizations, which are moving fast in this type of scenario. So financial institutions are faced with a great challenge, and most probably they will have to commit themselves even to more digital innovation. I think Elizabeth showed a very nice result of her survey, and this was very informative. But I fully agree with Elizabeth. I think also Paolo mentioned this. Technology is not an issue. I mean, the issue is having a new cultural mindset and having some kind of financial education. So whenever I consult with companies, from different areas, they are afraid that they have old technologies, and I kind of always tell them your old technology is people. Unfortunately, you have to change the mindset of your people if you really want to embrace the technology, and this is really problematic. There is also a very important issue of trust, which emerged. I think Paolo Ciocca also mentioned this. And while Paolo was mentioning this nice notion of augmented trust, which is also more vulnerable, I was thinking in my mind of all the notions of trust I went through on my life. I started with personal trust, like shaking hands. That was trust for me a long time ago. Then brand trust, then platform trust, and now we are on the algorithmic trust. We trust not even platforms, we trust algorithms. And in this scenario, I think thinking about an augmented trust for financial institutions is very important. If I really have to be sincere, to me, the current situation is somewhat reminiscent of the wildcat banking phenomenon in the United States. In the 19th century, in the second half, I think, during the Western expansion, really the new frontier, I mean the new territorial frontiers, there was an explosion of banks. They were called wildcat banks because they were in very remote locations. And because there was a huge demand and there were no regulations, they started printing money. There were money or offering many financial products. Because there was a huge demand, I can see a lot of parallels between this wildcat banking system that of course collapsed and was a very, it was a disaster with many things that are happening today, especially in the crypto market. So I think we should be, aware of this, and we should work and, work with regulations and try to prevent this new phenomenon that happened centuries ago to happen again in a new form. I think the only certainty that we have, especially after these great talks today, is that we face times of great uncertainty. That's the only certainty that I can have. And but I took personally one of the very important take-home message. It's a complex world. It's a complex problem. We need to work at an international level, and especially we need to cooperate and to work together. Problems are so complicated, cannot be tackled from just one aspect. There are many disciplines which are involved, so we really need to work on a multidisciplinary fashion. I think that's a challenge, and we have to meet this. So thank you so much.
Thank you again. Done.
I switch off or?
It's off. Yeah, sorry.